Yo, what's up, guys? It's JJ. Back with some content. It's been a while since I've hopped on the call and sort of put out some content, but yeah, I'm going to be putting together sort of a boot camp call, just sort of going through every aspect of my trading, every topic, and sort of every area and detail that I use, and then eventually sort of putting it all together to come to sort of the strat that I'm using at the moment. My entry criteria and my sort of checklist, which I need to see before I enter a trade pretty much every day of the week. So, and yeah, obviously at the end, we'll go through lots and lots of case studies, but yeah, we're just going to be sort of breaking it down by topic. I have no idea how long this recording is going to be. Could be like 3-4 hours. I have no idea. It depends how long it's going to take me to sort of go through and record all of this and explain it across. I want to make it as informative as possible and use a lot of live chart examples too, just so you can sort of hear me rambling on, explaining things and showing you good examples of stuff. But yeah, I'll give you a quick breakdown on sort of how the call is going to go. So to start with, we're going to sort of give an introduction to algorithmic theory, and where this thought process can essentially be derived from, and some details about it. And then obviously throughout the call, we'll be able to dive deeper into the algo and explain more of the theory as we're actually showing stuff. It will just make more sense. And then in terms of technicals, obviously we're going to be focusing a lot on liquidity, the actual sort of cycles, the liquidity trading that we use, obeys upon all types of trappings, a lot to do with sessions, so session liquidity, and most importantly, the characteristics of sessions and ranges and timings, stuff like that. Trap timings, we're going to have all the necessary cycles, so lower time frame, higher time frame liquidity cycle, and then cycles for our bias for future price action, so daily cycle and weekly cycle. We're going to be talking about a lot about structure, but not necessarily the structure you may use, but more so looking at structure in terms of liquidity, also known as algo structure, which is a big part of our trading. Things like that, a lot to do with volume, money transfer, sort of choosing the right areas, knowing which levels are the correct sort of key draws on liquidity, sort of early liquidity trappings, so fake breaks of structure, fake changes of character, smart money traps, all types of different models. And also we're going to sort of touch on some little details about specific types of algos which operate in the market. So for example, time weighted average pricing algorithms, volume weighted average pricing algorithms, things like event driven algorithms, smart order routing algorithms. There's plenty which we can sort of touch on here and there just to sort of give a good insight. And then, yeah, as I said, quite a lot of case studies towards the end. So it's going to be quite a chunky session, but we're going to get through it. We're going to smash through everything. Thank you for purchasing this recording. I've put a lot of time into it. I sort of advertised it on my story and thought, if there's enough interest, then I'll put something together. There was quite a lot of interest. So I thought, it's going to be worth me sort of putting something quite detailed together. I wouldn't, I can't just do things lightly. If I do something, I take it serious. So I'm going to be putting a lot of effort in, putting a lot of time in. I've planned this call and stuff. So yeah, it's going to be a blast. So let's get ready. So let's make a beginning, and we're going to start talking about sort of the context behind algorithmic theory, where we can sort of derive some of these concepts from. So to begin with, the most sort of important thing to know about the market is it can be described as a zero-sum game, which means essentially for every buy transaction, there's an equal corresponding sell transaction, which is sort of matched upon each other, and of course vice versa. So you can look at the market as there's always an equal amount of buys compared to sells. However, the thing that changes in the market is sort of the formatting of the data. So at certain areas and price points in the market and at certain times, there may be a certain amount of buy orders at this particular level compared to sell orders. And that's where we can sort of derive our strong liquidity points, where we have that sort of large imbalance of buys compared to sells at a particular price point. So the thing to know about the algo, well, essentially the algorithm is AI based, run by a supercomputer, uses very complex mathematics to operate. And this, the algo will essentially use data to run. It doesn't know what a chart looks like. So the algorithm doesn't sit there and see highs and lows. It doesn't see support and resistance. It doesn't see supply and demand zones. The algorithm just knows data, and what data is liquidity, which is a magnitude or a particular amount of orders at a certain level at a certain price point. So the algorithm just knows that at this level here we have this much money resting here, and at another level here we have this much money resting here. So it doesn't see an equal high or support and resistance or supply and demand. It just knows that there's an imbalance and a formatting of data. So like, okay, at a particular level we have a high amount of liquidity or a high amount of transactions resting there, and then we may have slightly less, and then we have a larger amount. So obviously the differ between a large amount of liquidity in the market and a lower amount is what we'd refer to as an imbalance. And the large blocks of data is our sort of key liquidity points we're going to be sort of talking about. So the algorithm is essentially attracted to these data points, and like I said, using mathematics, it can calculate the most cost efficient way to inject and produce market movement to attack these data levels and like liquidity levels, in which it can in result harvest the liquidity, which is quite a good analogy. So come to a level and harvest liquidity, take it, and then from there move to its next desired location, and making a profit sort of as a result of that movement. So another thing to know about the market is that if liquidity exists, then manipulation is always going to exist. And you need to sort of look at the market in terms of numbers and orders of magnitude. The chart is just a graphical way to represent data and the actual layout of data formatting in the market. So the algorithm doesn't know the chart. It's just we can see the chart and use the chart to our advantage. It's just a graphical way to display transactions and data on a database, which an algorithm is using, and applying mathematics to calculate its movements. Of course, the way the algorithm runs essentially is that it requires a large amount of capital to inject and move the market. So it's essentially hedging large funds and large private equity and large capital injections to actually move the market to its desired sort of levels. The most fundamental thing to know about the market is the market always focuses on taking liquidity and building future liquidity, and these two cycles will occur in harmony with each other. So always pay attention to how the market will take liquidity, but prior to taking liquidity, it will induce more liquidity, and then after taking liquidity, it will induce future liquidity and build future liquidity. So once we've took a liquidity point, this area may have then become a liquidity point in a future price cycle. So depending on the time frame, the perspective. So a 15M drawn liquidity could become a 15M liquidity target in future for the next sort of 15M liquidity cycle. So once we have our next drawn liquidity, this area could become a target. So once a certain liquidity drawn has happened, price will be like, okay, right, now it's time to come grab this high again and continue the sort of order flow of the market to attend higher time frame directions and key levels, which is sort of trying to target. You know, the market's fractal, of course, so everything. A good way to look at it is it's like an onion. So as you peel away a layer, there's another layer inside, and you can keep going all the way to the smallest layer right at the core. Hopefully, that's a good analogy to sort of recognize how the market is fractal. So, say you know the 1M liquidity cycle evolves around the 15M liquidity cycle, which evolves around the 1 hour, the 4 hour, to the daily, and then all of that plays a part in sort of monthly liquidity cycle. So, you know, a big way the market will create liquidity is by inducement. So, you know, by definition, what is inducement? Well, in our market, inducement focuses quite a lot on emotions. As an AI or a computer-based program or algorithm, it doesn't have emotion, of course. It can operate without emotion. So it's going to take advantage of human emotion, as that's the one thing it has an advantage over. So as well as human error, it has an advantage over that because it's an algorithm, of course. So the market will play very smart psychological games to induce liquidity, which is, you know, essentially getting people involved or getting people in early or at the wrong time, taking advantage of emotional and uneducated traders or inexperienced traders, sort of generate more liquidity, which will act as sort of propellant for future sort of injections and liquidity runs, essentially. The market likes to have a balanced sort of equilibrium condition because balanced market conditions allow both buyers and sellers to be sort of satisfied with placing orders. So when the market has repriced at a fair level, both buyers and sellers are sort of equal. You know, a certain person buying a stock or a security at a certain price, there's also people on the other side of the transaction who are willing to sell it at that same price. So a fair exchange can occur. This is when the market will typically have the largest amount of liquidity. Essentially, it can be known as accumulating orders. And then post an accumulation, the market is likely to then manipulate these orders. So once a sufficient amount of liquidity is generated on both sides of the market, and the important part is the market does like to induce liquidity on both sides at the same time, and then essentially take liquidity from one side of the market. So essentially push the market up and take out sell side liquidity. And then after, you know, a sufficient amount of liquidity has been taken, then reverse to come take out the other side of the liquidity. So the market focuses quite a lot on, you know, build up on liquidity on, you know, on each side of the market. One side gets taken and then you can trade that to the next side of the market. But, you know, essentially as price takes one level of liquidity, market conditions start to sort of become slightly imbalanced. Price is not at optimal pricing for both buyers and sellers to be satisfied with sort of getting involved with transactions. So if the market pushes up to a certain price, this could, you know, reduce market liquidity because people are in fear of taking sells because of how aggressive the market's moved up. But then at the same time, people could be buying because they're trying to catch the big pump up. So it's all a big sort of mind game. It's all a big cycle. So one of the most important things we're going to learn sort of throughout this call is how to spot the correct liquidity points, the correct sort of draws on liquidity, as well as, you know, types of algorithms which take place in the market. So for example, as I mentioned earlier, so time weighted average pricing. So sort of how the algorithm will divide its injected capital based upon time, and how this then takes part in our key timings and the daily cycle as well as the weekly cycle. And then 2, we have like volume weighted average pricing, which is how the algorithm would distribute certain amounts of liquidity in different volumes. So a large volume here, small volume here, a mid volume, sort of trying to accumulate, and then expand, manipulate orders, reaccumulate, take out more liquidity, sort of, paying attention to the whole cycle. More we're going to learn about is types of spoofing algorithms. So how sort of fake demand and fake demand and supply, and how a fake bias can be created in the market. And another type we're going to learn about is event-driven algorithms. So how certain algorithms are programmed to sort of manipulate news events. There's a model we have around news events. Obviously, we're not trading news because that is risky with slippage and stuff. It's just completely gambling to do that. However, post news events, the market always moves in a similar direction. News highs and lows, always very strong liquidity points, and the way the market sort of plays post news events are quite interesting. So that's like another sort of little detail we'll just touch on for a small amount of this call. So yeah, that's been quite a nice introduction to the algorithm. We're going to start off taking a look at sessions. I want to make sure I cover everything from start to finish in this call. Don't want to miss out sort of any details. So I'm just going to cover things properly, and we have to go through the boring stuff, but we also have to go through the good stuff, the techie pieces of information, because we want to have a whole market perspective at the end of this call, which will then sort of put things into place when I come to covering my strategy at the end, my sort of checklist, what I'm working with at the moment, what I've got plenty of back-tested and live data on at this current point, and it's simply just how I view the market and how I trade it on a day-to-day basis. So yeah, it's going to be a good call, I can tell you that. And yeah, let's get straight into sessions. All right, so the first thing we're going to get into is talking about the Asia session range. We're just going to go through all the sessions and start with Asia. So there's quite a lot of important characteristics to talk about with the Asia session range. One of them being the sort of high levels of liquidity that the range sort of includes, both obviously the high and the low, and how we can sort of trade them and use them, typically in London session, but also throughout the day, and how they can set a sort of direction for the day. There's also another sort of characteristic to the Asia range, which we can use to sort of determine the day's direction. So that's the first thing we're going to jump into. So let's hop on the chart now and take a look at it. So on my chart here, this gray range here is the Asia range. So what we're going to be paying attention to first is the direction in which the range closes. So by that, I mean, for example, the Asia range here opens at this particular price level and the session closes here. So in other words, you could describe the Asia range as closing bullish. So it closed at a higher price than what it opened. So what does this actually mean in terms of, the bias or what can happen for the day? So essentially, when the Asia range closes bullish, this could be quite a good indication that the day's price action is going to close bullish, or in other words, the daily candle is going to close bullish. So, for example, in this particular day, so the Asia range closes bullish, and as a result, the day closes bullish up here. So typically, say if the day is expected to close bullish, we may see price trade down to take liquidity. So for example, in this particular day, price looks like it came down to harvest liquidity below Asia low, and once it's taken this liquidity, it's then able to establish its daily direction and close where it wants to, in this scenario, bullish. So yeah, so a bullish Asia range can result in a bullish day, and obviously it goes the same for bearish. So a bearish day of a bearish Asia range can result in a bearish day. It's a very strong confluence, and the most important thing to sort of be aware of is if we are expecting a bullish day, the range closes bullish, you can expect price to particularly sell off maybe during London session to come and take liquidity out, and then we can sort of establish and confirm that daily direction, which you can see what exactly happened here. The Asia high and Frankfurt high, which is this little pink box, but we'll get on to talking about that soon. You can see that the Asia high was used and taken as liquidity, the liquidity that rested above this high was transferred within here. You can see the mitigation or money transfer, which is another concept we're going to talk about. And we've also built up lots of liquidity. Money gets transferred here for the second time, and this fuels our move down to come and harvest liquidity, which rests all below this sort of Asia range and these Asia lows here, particularly the low of the whole range itself. You can see price aggressively. Aggression is another key characteristic we're going to take a look at throughout this session. It's a very sort of key characteristic of the algorithm, something definitely very important to pay attention to. So you can see the algo kicks in, injects a lot of capital into this move down with the purpose to grab this liquidity here. And once this liquidity has been grabbed, money gets transferred in here from weak to strong hands. And then price injects back up with the liquidity that was taken here and establishes the day's direction. So that's a very nice example. We can just follow price along. So this example here, you know, the range opens here and it closes here. So once again, we've had a bullish day. Price takes liquidity. So above these two equal highs, which had been engineered the previous day. So there's a generous amount of buy side liquidity here, as well as the Frankfurt range high, which gets taken. Price then sells off within this area here, comes down to grab liquidity. So we can see that price has taken out this internal range of liquidity and looks like it's came to mitigate a level down here. And now once liquidity has been taken and price is sort of happy to accumulate and then inject orders back into the market, we can then close off with a bullish day, which is very nice, a bullish direction for the day. So the next day, the price opens here and we close. We open here and we close here. So you can see we've had this slight bearish trend within the Asia range. So the same as a bullish example, however, just the opposite way around. So we can expect a bearish day, which we can see price eventually in New York pushes down, and we can close the sort of main key trading hours for the day bearish. We can see that, you know, early on in the day, London session, price injects capital at London, which, you know, we'll talk about London too being a sort of key kill zone for the algorithm. So London session injects a lot of orders into the market, mainly to take out this liquidity, which we can see resting all in here. We also come to mitigate a key level up here, which we're going to get talking on to sort of liquidity and mitigations, all this sort of stuff later on throughout the session. So price early on takes liquidity for the day, and then this gets used to fuel the move down, which establishes the bearish direction for the day. You know, you could expect entries within here because you have a bearish sort of bias for the day. You know, we can see we've got a lot of resting liquidity existing underneath these lows, and you know, we know that when the market sort of, from what I explained earlier, talking about the algorithm likes to build liquidity on both sides of the market. So, you know, buy side liquidity and sell side liquidity, one side gets taken and then you can trade down to the next side, target this. This is a good example here. And then sort of following on after building up more liquidity, and maybe potentially want to come to target different levels, there could be potential sell opportunities inside of here, taking out liquidity, resting within here, mitigating levels and coming down to raise further liquidity. So looks like a sort of similar scenario again with the bullish example. So the range opens here and it closes up here. So we've had a bullish correlation for the Asia range. In this example, Asia low liquidity gets taken, Asia high liquidity gets taken. Looks like we also took out this previous high. This high is a very significant liquidity high, mainly because of its aggressive characteristics, a nice aggressive in, aggressive out. Usually with this large wick is, you know, it's going to store a large amount of orders, hence the aggression, which sort of signifies the large amount of capital we use to inject the market into this level. So this is also another key level for this sort of algorithm to take, and then this gives a nice reaction to come down, take more liquidity out and push the day bullish. We're gonna get back into it. So where I was at, I was talking about this Asia range here. So yeah, we had a bullish session, took liquidity on both Asia high, Asia low, and as a result, the day ended bullish. Looks like price wanted to take out a higher time frame liquidity level, so in this instance, sort of the daily sort of direction and target looks to be to take out this 4-hour high. So, the higher time frame appears to be satisfied with taking this 4-hour high to continue bearish. So once this liquidity has been taken, we may expect price to sort of want to be bearish from here onwards. We know that there's a lot of liquidity resting here, typically because this aggressive move is going to have lots of sort of capital which has been injected into this. Going to be lots of resting orders, and you can see from the previous day that this low never got violated. So all this liquidity is still existing underneath this level. Lots of transactions, and this is also a very high incentive, like sort of buy level for a lot of traders, especially retail traders. But from our sort of high time frame analysis, we could have perhaps expected sells from high time frame liquidity points. We can see price very aggressively rejected out of here. So perhaps this could become a potential sell zone off a breaker block. But, we're gonna get talking about all that stuff later. But if we were to expect sells, the easiest sign, the first sign of the day is the direction which the Asia range closed. So in this particular example, the Asia range opens here and it closes here. So you can see, we've had a bearish correlation once again. Price trades back up at Asia close, takes out liquidity, and then we continue bearish. And then from there, price sort of reprices into a more fair price level, allows sort of more traders to get involved, and then continues down again. So, you can see how sort of the Asia range can be used in quite a lot of senses, to take trades sort of after a take of liquidity. The Asia session, it's a very high liquidity session, and London session usually sort of likes to use Asia liquidity to sort of establish its direction. We're going to get on to talking about London session coming up very soon, but since London and New York require quite a lot of liquidity to move, Asia session is sort of usually quite an easy liquidity point to sort of raid. Asia session high and low also sort of contain lots and lots of liquidity because there's very large stock exchanges being traded in these time periods. You got Tokyo Stock Exchange, for example, sort of trading lots and lots of money, billions, trillions of dollars. So we've got a couple of important things to take away from this. So the main ones are a bearish range equals a bearish day, bullish Asia range equals a bullish day, and Asia high and low are important liquidity levels. So there's also one more sort of important thing to talk about Asia, and that's the key sort of settlement time, and what is the real sort of Asia range timing. So we're going to talk about this now. So this is specific to the CLS algorithm or settlement time algorithm. So the sort of key Asia range timings which I use, this is in GMT, which is UK time. So if you're from a different time zone, you're going to have to sort of change this to your time zone. But key Asia range timing, so what I use is 11 p.m. till 5:30 a.m. That's in UK time. So yeah, just translate this to your time. But 11 p.m. till 5:30 a.m. is going to be the most accurate sort of Asia range timing you can use. It's very important to get this accurate just for the sort of high and lows and the direction. Sometimes it can be quite fiddly. So yeah, it's important to get this correct. So this is the sort of correct timing you want to be using. So I'd advise you to sort of start using this on your charts. Yeah, that's sort of all we've got to cover about the Asia range. We also got to touch on some other sort of little liquidity points here, and some other sort of basic concepts which we're going to dive a lot deeper into. So next we're going to sort of move on to the Frankfurt session, and then from there London session and New York. And then we're just going to wrap up the sessions, talk about the trap timings, and then we can get onto some proper sort of technical price action analysis, liquidity, entries, confirmations, all sorts of things, gathering a bias, everything sort of important to our traders. So yeah, let's move on to the next part. So let's get on to Frankfurt Open and the Frankfurt session range and sort of how we can use that in our trading too. So the Frankfurt session is just after Asia and also just before London. So for those of you who trade London or even New York throughout the day, the Frankfurt session can be extremely useful. There's quite a lot of sort of features to the Frankfurt range and Frankfurt opening price, which gets used in my trading, which I'm going to go through all of it now. But to start off with, we're just going to go through the actual like specific timing. So this is obviously in GMT, which is UK time. So Frankfurt session range is 6 a.m. till 7 a.m. GMT. So yeah, you're just gonna have to convert this to your time zone, depending on where you're from. But on my chart at the moment, this purple range here, which is, you can see 6 till 7, this purple range here represents the Frankfurt range, and obviously the grey represents Asia. So Asia, well, so Frankfurt liquidity is usually used pre-London session. So it's another type of liquidity that London may want to use as sort of fuel, to sort of create, maybe the protected daily high, daily low of the day, sort of to start off the day's price action and create them London moves. So there's quite a few characteristics that we're going to go over with Frankfurt. But first of all, the easiest one that we're going to cover is Frankfurt high and low being sort of used as liquidity. So say pre-London session or at London Open, usually to fuel the London move. Frankfurt as well as Asia, which we covered earlier, can be used as liquidity. So for example, say in this particular price action here, let me just pull this over. So we've had a higher time frame draw on liquidity. So this is like a 1 hour, 4 hour draw on liquidity, and dropping to the lower time frame. You can see, prior to this draw on liquidity, we've had a nice market maker model. So this is essentially just a range of price action, and then one side gets liquidated. So we can see we've had this sort of pattern. Prices liquidated one side, left behind all this liquidity up here. So we could expect buyers to take out all this liquidity, and this paired with the fact we've just taken out higher time frame liquidity, signifying that we may see a money transfer and then a shift away as a result of this grab of liquidity. So it's definitely a sort of high probability area. Take into account higher time frame bias with it too. I'm not going to go into that yet, but take into account things like that. You could get a good bias to take longs around this area. In this case, potentially targeting this imbalance here with liquidity here to be taken out, and then to continue shorting the market downwards. You can see the market's left liquidity, so shorts would make sense. But so yeah, dropping, not to get too far ahead, dropping back down to the lower time frame here, you can see that as price took liquidity here, we had this nice aggressive move down, this nice aggressive push here. Also what we know as a vector candle, which we're going to speak about a bit later on too. And since this this low was put in, we can see prices shifted since then. We can see the momentum start to kick in, back bullish again. The significant thing to note here is, price doesn't actually take out any sort of important liquidity. So, hence a pullback from this area back into, this sort of back into this price leg here. So any type of pullback into here, could make sense to buy. As you can see, we've still left liquidity. However, the market's shown its attention by, giving a break structure and, nice bullish momentum to the top side. We've got lots of liquidity, Asia high equals highs, and plus, expecting a reaction off this higher time frame level. So, it's definitely still sort of valid, and makes sense to take buys from this area. So as you were sort of potentially looking to take a buy, as price starts to pull back, we can sort of hop on the higher time frame. Well, we can see here that we have this nice protected algo candle, which we're going to talk about. We're going to sort of dive back into this stuff later on a lot deeper. But the important thing which we're talking about currently is the Frankfurt range. So we can see how the Frankfurt low in this case is going to be used as very nice sort of liquidity or inducement in this case. Another thing we're going to talk about later. But the important thing to note here is that as London session opens, so the London session opens at 8 a.m. GMT for me. So we're going to get into London a bit later. So this is just the London open range, or essentially the first hour of the London session. We can see London pretty early on uses the Frankfurt range as liquidity. Comes down to mitigate a level. And from here, you could see a potential buy opportunity, which we could see price to continue on pushing to the top side and eventually delivering to liquidity levels. We can see we have sort of a short reaction off of this liquidity level, and then price continues, and eventually to target sort of a higher time frame or potentially your target. So this is quite a good example of when Frankfurt has been used as liquidity. It's a very strong confluence. So say if you was unaware, if this wasn't Frankfurt, then the fact that these lows here contain Frankfurt liquidity just sort of strengthens that liquidity zone. We've also got other confluences such as price leaving behind trap zones off of this sort of supply zone here, but we're going to talk about all this juicy stuff later, so get into what defines that sort of trap. But yeah, essentially the main thing to sort of take from this is Frankfurt high and low being used as sort of quite important liquidity levels for the trading day. You can see this beautiful algo structure here where Frankfurt high gets taken out and absolutely melts from there, etc. But there's another sort of important detail to get into when it comes to the Frankfurt range. So since Frankfurt and Asia are pretty close to each other, the Frankfurt range is sort of straight after the Asia session. One thing to note is if the Frankfurt range takes out the Asia high, so say we have the Asia range here. This is our Asia range. This is our Asia range. So then Frankfurt session opens and Frankfurt session takes out Asia high. So this here is the Frankfurt high. Usually what happens when the Frankfurt session takes liquidity, it usually doesn't hold. It can be a very weak grab. So say this happens here and then Frankfurt closes here, then price can come to take Frankfurt high. So it may look like Asia high has been taken and then the high which took Asia high has been taken again. But however, since this is Frankfurt high which took Asia, there's a lot of liquidity still resting above here and it typically doesn't hold because London session is when the real sort of injection comes into the market, and hence will take sort of Frankfurt session out. So we're just going to hop into some chart examples to find this, find a few examples of this. So for example, just go here. So you can see how the Frankfurt range takes out Asia low. It tries to hold, and as a response, it fails. Frankfurt low is weak. Literally the same exact thing here. Frankfurt takes Asia liquidity, fails, and it's weak. And here again, so Frankfurt range takes out Asia high up here. We put in this high here, which is Frankfurt high. We start shifting off of Asia, trade back into it, and it fails. So, a sort of important thing to note is that Frankfurt session grab of liquidity is weak, especially, usually when it takes Asia high, especially Asia high. So this can obviously sort of help you from getting liquidated from quite a few moves, sort of prematurely getting into sells or buys off of maybe Asia liquidity. If we see that Frankfurt sweep, we can expect potentially another sweep after this and then continue down from there. And your sells could be up here and along, continuing your potentially bearish buys for the day. And obviously, like we were talking about when we talk about the Asia range, you could gather this bias from, if the Asia range closes bearish, then expecting a bearish day. So if you're expecting a bearish day, then you'd expect Asia high to be taken so that it can be used as fuel to continue down. So yeah, that's cool. There's a good bit of sort of detail on Frankfurt session there. We've still got a couple more things to cover. We're going to hop back down into this example. This is quite nice. So another sort of important thing to pay attention to is the Frankfurt opening price. So, what is the Frankfurt opening price? It's literally the price level at which the Frankfurt range opened. So, for example, let's have a look here. So the range opens at 6 a.m. We've got this bearish candle here. So we open here and we close here. So you can see the Frankfurt range opened at this exact price level here. So let's just mark this up as the Frankfurt opening price. So what use is the Frankfurt opening price actually to us? So let's have a look, shall we? Let's draw it across. So this is the Frankfurt opening price. Well, the Frankfurt opening price can be used to sort of help determine which levels may become a trap. Price likes to sort of surpass this Frankfurt opening price level. So what I mean by this, let's go into a bit of detail here. So this particular zone here, this valid sort of POI to be looking at, we have very, very valid liquidity underneath here for price to sort of liquidate. You may be expecting price to come into here, take out this liquidity, mitigate, get your lower time frame confirmation, blah, 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 and the price to continue buying. And, you could see yourself being a buyer in here. However, where does the Frankfurt opening price come into sort of play here? Oh. So we want to be taking trades. So for example, we want to take a buy. We want this price action to surpass the Frankfurt opening price range or the price opening level. So what I mean by this is, if we're looking to buy, we want to be buying underneath the opening price. So say how this level here, this sweep of liquidity here, is at the Frankfurt opening price, above the Frankfurt opening price, whereas our sort of entry or our level to play, we want it to be below the opening price and then to continue up. And obviously the same thing would happen for sales. So say this was the Frankfurt opening price. Let's just draw it out nice and clean. So we wouldn't want to be taking any sells off of levels which are below that Frankfurt opening price. We'd want price to surpass it, to go above it, and then we can sell. So in this example, the reason why I wouldn't look at this zone is because it sits on the Frankfurt opening price. However, this level is below. Hence, we could expect price to likely want to come to this level to continue up. So you could draw out a little diagram for this just to sort of make it nice and clean. So we've got I'll do. So let's say Frankfurt opening price was here. And potentially you were looking to take and buy off of the sweep of this liquidity in here. Well, this sweep of liquidity is above the Frankfurt opening price, and since we're looking to take and buy, we want to be, for more confirmation of our level, we'd want to be taking a buy from below this level. So hence, instead of looking at this level, we could mark this out as a trap. So maybe a London open trap. So as London open kicks off, we start pushing towards Frankfurt opening price. This zone could be seen as a trap, and as a result, this level may be more high probability to us. We have liquidity here to be taken out. We have nice imbalance within this leg, which can be filled, and it's below the Frankfurt opening price. So we have nice sort of confirmation around this level. Perhaps even more confirmation is that this level took liquidity. So we sort of see this as a stronger POI. So it takes liquidity here. It's got inducement, or it's got liquidity here. We're going to touch on these things more later. Below the Frankfurt opening price, and hence this level sort of holds and delivers to the high and takes liquidity there. So so essentially, we want to be taking buys from below Frankfurt opening price and sells from above the Frankfurt opening price. So that's sort of the most important things to know about the Frankfurt. We've got multiple implications in which we can use it in our trading. I don't really have this sort of rule based. However, it's just like it all forms a part of my bias. So, it's used in my analysis for liquidity and what levels are going to sort of play to provide the moves for the day. So, and obviously for Frankfurt opening price, using that as a sort of level for determining, which zones are more likely to hold than others, to catch, the high probability entries, and be well positioned in the market. So cool. The next sort of session we're going to be moving on to is talking about the London session. So the key characteristics to know about London session is usually the London session, or the London opening price, which I consider sort of the first hour of London session, will typically create the protected daily high or protected daily low, depending on the day's direction. So currently on my chart, you can see the blue boxes. So obviously we spoke about the pink one being Frankfurt. So this blue box here is the first hour of London session. So the first hour is key, since this is the sort of time which is usually responsible for putting in the protected daily high and low, and it's also when usually the sort of momentum comes in. The sort of initial key momentum comes in for the London session. So I'm going to drop the time here. So this is in the GMT timing, so UK time again. So just have to convert it. But I use 8 a.m. till 9 a.m. GMT. So just this hour of price here. So let's just sort of study. This is just the same price action we were looking at Frankfurt on, but let's just sort of study some movements of the London session. So we can see that as the London price opens, London takes liquidity out and mitigates a level here. But the key thing to note is that, as London session opens, we can see we have this large injection of liquidity into the market here. And then we can see at the end of the first hour of London, this low is put in here. And as a result, this low here has become the protected low of the day. We can see that price comes back down to sort of mitigate this level and continues to hold throughout the day, forming this as the low of the day. So, we can see that, London is responsible for these large liquidity injections. Usually, it's going to sort of take liquidity off some point, and London will technically take liquidity and use that liquidity as fuel to sort of fuel the day's direction. So essentially, in this example, we can see price has took out this high time frame liquidity level. London open took liquidity, and then we had a money transfer off of here, and London low takes liquidity and forms the protected low of the day, and the price closes bullish. That is the sort of daily scenario in terms of London for this day. We can see once again here the high in London session is the protected high of the day. So throughout this day, this high has been protected, and shorts have just sort of held throughout the day. It's a sort of, you can see in this sort of day of price action here, London, just outside of the first hour, however, still in the London session. It's formed the protected low of the day, which is held throughout the day, where you could have been a buyer along this way, buyer here, potentially following the sort of daily direction, knowing that this low is going to be the protected low of the day. Once again here, you can see as the London session opens at this price level here, we have a nice sort of injection of liquidity. This is just to take out liquidity, and this, you can see this liquidity. Let me change the color of this real quick. So the liquidity that exists underneath this low here gets taken and is transferred within here, and then the liquidity is used to fuel the move up. So London here, London low within the first hour, as sort of take liquidity and use the liquidity to push for the daily direction, and as a result has remained protected throughout the day. Sort of draw a straight line, you can see that this low never gets violated. So essentially, London creating the protected high or low of the day again. And then the same for this example here. London high forming the protected daily high of the day. We can see price, does it violate? No. So there you go. Once again, this high has been respected, and the high formed is the protected high of the day. So you can see that this is a very reoccurring characteristic of the London session. And all this session knowledge we're sort of gathering here, we're going to eventually put together and form what we call the daily cycle, and then from there we can also then talk about the weekly cycle. So yep. And we can see on this day of price action 2, we had a large sweep of liquidity, and then London session kicks in, gives a nice kick of momentum, this high is the protected high of the day, and from here onwards we have a bearish day. And just like what we were talking about earlier on this particular day here, you know, how London is used to sort of kick in that initial liquidity injection with the purpose to take liquidity. Once liquidity is being grabbed, price can then transfer and continue with its chosen direction to take out more liquidity and come to more sort of favored levels by the algorithm. And this low here becomes the protected daily low. So you know, you can see how this sort of theory repeats. And you know, this can be very, very sort of important for entries, especially obviously if you trade London session. You know, when London comes and takes large liquidity, we start to sort of give a money transfer off of here, knowing that this high was formed in the London session. Sort of gives us good confirmation this is likely to be a protected high, in which we can then short the market from here onwards. Obviously with a bearish bias in mind, potentially, you know, to target liquidity levels as such. So, you know, just like as example what we were talking about earlier with this buy here, you know, we've taken out higher time frame liquidity all the way over to the left here. We've taken out higher time frame liquidity. This liquidity gets transferred within this level and then used to push the market up to come and take more liquidity out. So, you know, you have your bias there to be a buyer. Then, you know, putting together sort of other things we've learned. So about the Frankfurt session, so, you know, we've took out Frankfurt liquidity. It's below Frankfurt open price. London has kicked in this nice sort of initial injection into the market. This low here mitigates this level within London open. So, you know, once we sort of start to see this candle here, this candle closing sort of as a rejection from this level, we start to reject out of this level. You know, you could potentially take a buy from here if you're happy with your confirmation, but you know, we're going to get onto sort of confirmation and everything later on. You could potentially be a buyer from this level to target potentially Asia high liquidity, as well as this trap level here which has been created, which, you know, we're going to talk on, you know, what identifies the trap layer. So this is sort of potential trade opportunity, talk about the confirmations with all the session sort of theory we've been talking about so far. And you know, the sessions aren't really confirmation. The settings are sort of what we use to put together to form a bias throughout the day, you know, and to obviously like try and get them pinpoint accurate entries, you know, trying to get sort of involved in the market at like correct, you know, good quality pricing levels in which we've got, you know, a high probability to ride these levels to the next swing points and sort of capitalize as much as possible. So, you know, I sort of covered the main points on the London session. Just jot them down and see I've got them as a note. So London forms the protected high or low of the day. So, you know, that's a sort of key point to know. So next we're going to be talking about the New York session. There's a few key characteristics to the New York session. Once again, we're just looking at the opening price of the New York session. So just the first hour of New York open. So essentially, the key thing to know about the open of the New York session is that it initially likes to sort of trap and sort of take liquidity as soon as it opens, which is usually used to fuel the remainder of the day throughout the whole of, you know, the rest of London and up until the end of New York, up to Asia. So let's take a look at this on the chart. So we're essentially looking for what happens at the beginning of the New York session. So as you can see on my chart, you can see these green boxes here. So as we discussed earlier, you know, this blue one's London, pink is Frankfurt, purple is Asia, just like we've been talking about. But these green ones are just the sort of the first hour of the New York session. So I'm going to put the time up here in UK time. So New York session, so 1 p.m. open. So this box is 1 till 2 p.m. GMT time. So taking a look at what the market does here at the open. So you can see how at the open price of New York, price takes liquidity, and then throughout the first opening hour, price comes down and takes more liquidity here. So this essential move here we can sort of recognize as like a fake breaker structure, since the beginning of the New York session took out this highs. It's more so just a liquidity grab, in which price just wanted to come down here to clear out these two lows here, and then since here we just have a money transfer and a sort of high probability level to enter yourself could be here. You've got a well priced level in terms of liquidity and sort of the market balance and cycle. So just taking a look at a couple sort of New York sessions, so we can see that on this particular day we have Asia high liquidity. Looks like there's quite a lot of relative equal highs up here. We can see that the New York session opens around here, and the first sort of push of New York session is simply to take liquidity. And now once liquidity is being grabbed, the market can continue in the opposite direction into which the New York session opened. So obviously if New York pushes up, once significant liquidity has been taken, we can expect the market to come down. So essentially what, to put it in simpler terms, what the New York open hour does is sort of create a trap, fake market trap. So we can sort of create pushes up, leave behind zones like this. However, since we've had a high time frame drawn liquidity, this zone is likely to trap here. So the New York session likes to create a trap. So going back to the example we we're just looking at here, so bearing in mind the New York session likes to leave behind a trap, we can see price leaves behind this nice trap level here. So this nice trap zone here, which we can sort of buy up through. So we've got that extra confirmation. We've got a nice build up of liquidity here. We know that this zone is likely to trap since it occurred in the first hour of the New York session. We've had this nice drawn liquidity here, given a strong reaction, and then we've had the sort of lower time frame confirmation entry where we've had a nice sweep on liquidity, paired with a nice sort of build up of trendline liquidity. So this could be sort of quite a high probability entry to take. You can see it goes on to run quite nice eventually. Yes, that's a good example of the New York session. Once again here, we can see the opening price of New York becoming a trap. So New York session opens, we create this push in the hour. You can see how perfectly, as the first hour of the New York session ends, that is where this specific pivot point is. So this first hour creates this fake move to draw liquidity, and it leaves behind a trap zone here, and price comes to take that out, comes and reprices higher, takes out sort of higher time frame liquidity point, which is it's better priced. So when we actually look at this leg of price action here, this entire leg, price comes to take out liquidity here. Since this is a more better priced level, we have a nice strong high here which takes liquidity, and then price continues downwards to break structure below here. So essentially, let's just do a couple little drawings here. So when we're having price action, the New York session opens, pay attention to the opening push of the New York session being trapped. And also pay attention to whether the New York session draws liquidity. So say we've had a higher time frame drawn liquidity, that sort of just gives you confluence that this New York push is going to trap and be taken out eventually. So let's have a look for another example. So we look at that one. Yeah, so you can see here, well, this is quite a good example actually, by the looks of it. So just mark this. So you can see New York pushes up, takes liquidity, and then subsequently continues down, pushes down, come harvest more liquidity and come down to a more priced area. So essentially the demand level, or the low, the low caused in the New York opening hour, essentially is a trap and gets swept out here. So yeah, there's a little bit more detail to touch on when it comes to this New York session. This is another good example here by the looks of it. The New York session pushes to take liquidity, and then you can see as soon as the session, the first hour of the session ends, that's when the algo initiates its next price movement, which is to continue down, trapping demand zones and levels caused by this opening push. So, you can see how this is sort of very important intraday feature to look at, especially around the New York session. And if you trade New York, it's definitely very important to look at. So in terms of the timings, there's sort of there's two parts you can look at it. So obviously you have the first hour of the session. The important things to look at is where it opens and where it closes. So just like here, we can see that we open here, and we see we close here. So likely what happens is the fake move will come from where it opens, and then the real move will come from where it closes. So then we can continue down like this. So say this is where the fake move opens at 1 o'clock, and then at the end of the first hour, so 2 o'clock, that's when the real move is then initiated. And you can sort of likely be a trader in here, anticipating this level to be taken out and continuing with your sort of higher time frame analysis. So potentially in this example, your higher time frame analysis was to take out this low. Not nice liquidity that exists underneath here, and obviously price then eventually delivers there. Same as sort of these examples up here too. We've now sort of built relative lows here, which eventually, if you were a seller within here somewhere or here, price eventually comes and takes these out and maybe comes to your higher time frame points, such as these relative equal lows down here. So the sort of New York session and the characteristics around it in terms of the fake sort of trap that it can leave behind, and the 1 and 2 p.m. opening price, very, very important to sort of look at if you're trading intraday. Definitely something to sort of make a note of and study and get into. But that's about all for the New York session. So now we've covered New York, London, Frankfurt, and Asia. So we've sort of covered all the key important session characteristics, and sort of what we're going to be covering. Next, we're going to be getting onto cycles, so the daily and weekly cycles. So all the information we've learned about sessions can be put together into what we know as the daily cycle, and then we're also going to get onto the weekly cycle as well, and then sort of get onto more sort of price action evolved sort of analysis, really, rather than sort of looking at sessions. Like we've also managed to drop some gems about liquidity and stuff whilst talking about this, but this is mainly just been focused around sessions. We haven't really got the opportunity to sort of jump straight in and talk about liquidity and price action and sort of pivot points and entry types and all this other stuff, but that's all going to start coming now. So cycles, get onto sort of algo structure, liquidity, IPA, mitigations, traps, entry models, stuff like that. So yeah, let's get onto it. Right, cool. So we're going to start talking about the daily cycle now. So there's quite a few important sort of things to know about the daily cycle. What we're going to do first is just bullet point out the sort of key points to it, and then we're going to sort of look at some sort of diagrams and also some chart examples too. So daily cycle. So the daily cycle takes into account each of the session characteristics. So Asia, Frankfurt, London, and New York. And the daily cycle is essentially when they all play hand in hand with each other. So I'm going to draw up sort of just say like an example of a particular daily cycle. So cool. So let's just have a look at this particular price action. So over here we have the Asia range. Just make that purple. Then we have the Frankfurt range, that pink. Then we have the London Open, and then we also have the New York session. So, what are the sort of characteristics to this daily cycle? So this particular example would be the bearish daily cycle. So, what happened? We have Asia liquidity taken. We have Frankfurt liquidity taken. So, both Asia and Frankfurt essentially get manipulated. We have the London session forming the protected high of the day. Obviously, in a bearish example, would expect London to create the daily high, and if we had a bullish bias, would expect London to create the daily low. So this high is protected throughout the day, and then we have the New York session, which leaves behind a trap level, which then it gets taken out. Price comes to mitigate this level here, and we continue down, completing our sort of daily, bearish sort of bias, potentially sort of delivering to a daily sort of liquidity target, which we was expecting price to take out for the day. So the daily cycle is essentially all the sessions sort of playing hand in hand with each other. We may as well talk about it whilst we're here, but many times the New York session opening price will sort of be, act as inducement. So there could be sort of post New York continuation trades which could potentially be taken here. And with a bearish bias, the way you can sort of play the daily cycle, these are the sort of the entries you want to keep an eye out for. So the first one would be the sell at London Open. So this would be sort of either above the Asia high or above the Frankfurt high. It depends on this is sort of how it's laid out. So say it could look something like this maybe. So the Frankfurt high hasn't taken out Asia high. They just sort of get cleared together. You could take a sell in here. You could have to sort of make it more high probability, you're likely going to have some sort of higher time frame level, some sort of higher time frame liquidity. So potentially something that looks like this. So like that. So you have this nice higher time frame level, some sort of mitigation. We have the Asia liquidity. We've got price building liquidity. Your first sort of particular entry you could be looking for on a bearish bias would be the sell here. Then you have a sort of continuation sell, which could be say off of like a breaker block, or say within this price action here, this sort of London price action. If price sort of creates some algo structure, takes liquidity, we could be looking to get involved sort of along the way down. But we're going to get onto sort of algo structure later on. And then we have this sort of sell here, which is above the New York trap being taken out. So these are sort of the potential entries. Sometimes you can also get sort of like a hedged buy. So after sort of like Asia liquidity has been taken, you could get a hedged buy here. Maybe price would want to come and harvest more liquidity before coming down. So you could get sort of like a variation like this, and then this becomes the New York trap, and price continues down after taking this high. There's multiple, it's essentially like a snowflake cycle. It's going to look different day to day, and it's also not going to be perfect every single day. But the sort of key thing to pay attention to is the most common points. So the Asia liquidity, Frankfurt liquidity, as well as Frankfurt opening price. So you can see sort of in the drawing here, if we mark up Frankfurt opening price, lines up perfectly with the sell opportunity here above the New York trap level. Then we have London session creating the high or low of the day, and New York causing a trap. So the daily cycle works hand in hand with all the session characteristics. It's fractal, it's a snowflake pattern. It's not going to be perfect every single time, but you need to just follow sort of main characteristics. And vice versa for a bullish scenario, it's going to be the exact same, where we have the Asia range. We have some sort of liquidation of Asia or Frankfurt. London forms the protected daily low. New York sort of can create a trap zone like this, say, and we continue to push up and take it out. So yeah, just like in this example here, maybe New York opened here, so this could be the trap. So this push up is the trap. So you could then sell at the end of New York session, and then this is the trap caused here, and we continue down and take liquidity. So it's quite important to sort of pay attention to the daily cycle. It can really help completely just disregarding, high time frame bias and liquidity imbalance and rebalance, and other sort of algo structure, other factors of the market which we use, you can really get a good idea of sort of where the high probability areas are to sort of position yourselves. And then within these levels, you can then look for the lower time frame confirmation of say this higher time frame level up here where we've took out higher time frame liquidity. We've taken out session, Asia liquidity. It's London open mitigation. So, we could expect this to be sort of the high of the day. You can get your sort of manipulation set up, coming down to sort of target liquidity. So, from here onwards is where you'd look for your entry criteria within these levels, which, we're going to get onto all sort of entry criteria stuff later. But, this is a sort of very good gauge to sort of get an idea of where the actual entries in a sort of typical daily cycle are likely to be, where the sort of best places to be involved in the market, where you're at sort of fair, good quality pricing levels which are likely to hold throughout the day as swing points or hard time frame points. So yeah, that's it for the daily cycle. Take notes on it, study it, study every single day. It happens a lot. You can actually see sort of this example here where we have the Asia range, we have Frankfurt liquidity taken. London here forms the high of the day, so you have sell opportunities at London high, and then New York causes this trap level, so you could potentially have buy opportunities here to take out the New York trap, and then we may sort of see further sells, still under the sort of belief that this high here is going to be the protected high of the day. So say a level like this, which has a bunch of liquidity here, could potentially act as a potential sell zone. In this scenario, it looks like it doesn't play out, but that's because this analysis is completely irresponsible of the high time frame bias. So that's just sort of an example of how the daily cycle can sort of play out quite fractal as well. It's always important to understand this, it can be different on a daily basis and not 100%, but they're the sort of key points you need to pay attention to get positioned in the market. So yeah, that's cool. Let's get on to the weekly cycle next. So next we're going to be talking about the weekly cycle. So obviously the weekly cycle comes in two forms, for a bullish week and for a bearish week. They're slightly similar, so we're going to start talking about the bearish week first, and the sort of characteristics behind each day, Monday through to Friday, and what we can sort of anticipate each day to move like, and how we can sort of form an understanding of sort of a typical week of price action. So have a look at the chart, shall we? Oh, let's get ready. Cool. So, right, we have an example here on EU. The 5 different colors break down the 5 different days of the week, obviously. So Monday, Tuesday, Wednesday, Thursday, Friday. And obviously it's clear this is a bearish week of price action. So to start off with Monday, Monday is, it's usually going to be the sort of lowest momentum day of the week compared to Tuesday, Wednesday, Thursday, and Friday. This is usually because the market being closed over the weekend, the sort of liquidity at the start of the week is always lowest due to traders sort of closing out positions on Friday from the previous week. So Monday always starts with the lowest liquidity. So it's often Monday will sort of typically range price action in a bearish week. We'll get sort of just liquidity being built up, and this sort of feeds perfectly in with how Tuesday operates, since Tuesday is usually the sort of manipulation day. So Tuesday is where the sort of early manipulation of the week occurs. So in this case, we are expecting a bearish week. So the sort of opening price of Tuesday is going to look to take liquidity. Most of the time this comes in the form of clearing out the Monday range, and in this example we can see we've cleared out this liquidity level here, which looks to be sort of like a 1 hour high. And we've came to mitigate a level up here. This nice range here. So I'm just going to mark this. What's it going to be? So Tuesday has came and sort of manipulated early on. This is with the purpose just to take liquidity, to sort of begin fueling the move or the direction for the week. So yeah, the key characteristic to take from that is, Tuesday is likely to be the manipulation move, and this will also likely form the high of the week. So in this case, you can see we have a nice rejection candle here. No body, no candle body closes above this liquidity point, so we can confirm a strong rejection. And this high here is the protected high of the week. Price obeys this level throughout the week, and yeah, so essentially Tuesday has sort of taken Monday liquidity, taken liquidity from the previous week. That's a very important characteristic of Tuesday too. It always sort of look to take liquidity from the previous week where possible too, to then continue and sort of fuel the beginning of the weekly direction. And in this example here, Monday's low would become the sort of next break structure or next draw of liquidity to come, and for price to sort of continue delivering bearish. So that's Tuesday. So next we're going to talk about Wednesday and Thursday. So we may see some sort of acute. So after this Tuesday move here, we'll see some sort of push into the sort of chosen direction. So obviously we start to go bearish. Wednesday is typically the day which will confirm this movement. So sort of at the end of Tuesday, maybe the beginning of Wednesday, you may get a small sort of like a redistribution of price. So, a small build of liquidity, some sort of manipulation, and then a continue down. So Wednesday will typically sort of be that continuation move to Tuesday. So, Monday is sort of a range. Tuesday is the sort of manipulation move, and Wednesday is the continuation of that Tuesday manipulation move. Which, in this case, you can see Wednesday given a nice push down, taken out Monday's low. And now Monday's low has been taken out. This confirms the bearish week. And obviously, you need to use higher time frame and stuff to sort of get an understanding of what you want the week to do, really. So obviously, from this 1 hour chart, we can see that this chart is bearish currently. And without looking into too much detail, but perhaps you wanted price to continue down, take out some liquidity, and you was expecting a bearish week, then you'd expect this sort of similar weekly structure to play out day by day. So now Wednesday has sort of completed a nice bearish continuation and started that sort of nice push, that nice movement down. We'll get a sort of similar situation occur where price will sort of reaccumulate orders, and then Thursday usually has large momentum. So just like how Tuesday has high momentum to cause the manipulation move, Thursday will also typically usually have high momentum and carry sort of continue down into that bearish direction. However, it will also typically sort of generate and induce more orders into the market. So we can see how, after we've had a gram of liquidity, we've had a nice push down on Wednesday. We've then sort of began to have a pullback, and between the sort of overlap between Wednesday and Thursday, orders have been generated. And then Thursday has continued down, continued to break structure, built more liquidity, and built future liquidity above these highs too. And then coming to Friday is obviously the last day of the week. Friday will typically put in the low of the week. You can see how at the open of Friday, this low here becomes the sort of protected low of the week. And Friday would, it's likely to sort of, especially after Wednesday and Thursday, sort of continue with a nice bearish direction. Friday is likely to sort of reverse price. So in this example, obviously accumulate and begin to push up, so sort of cause a pullback. Generally to finish the week off in a sort of well-priced area. looks like price wants to come and sort of take out liquidity that existed in here and fill in some sort of imbalance in this level. So, you know, price is sort of ending up, you know, at a well-priced level, meaning that for the week start, Monday, for the next week, it can sort of start in a good position where you could see your range, and then Tuesday may sort of come to take liquidity again. And then we have that Wednesday continuation, accumulate again, Thursday continuation, and then Friday finishing off again. So it's all sort of feeds into each other. And you know, within the weekly cycle, obviously you can expect to see the daily cycle, which we spoke about earlier. So for example, London high forming the protected high of the day. You know, London open here forming the protected high of the day. Once again, London in here forming the high of the day, and between 8 and 9, so this low here forming the sort of protected high of the day, or protected low of the day in this case. Same with sort of Asia liquidity. You can see the Asia range here building liquidity and it being taken out, you know, taken, as well as then like sort of Frankfurt liquidity, and then also, you know, the New York sort of characteristics we spoke about earlier on too. So you can see how everything sort of falls within each other. So the daily cycle is like a bigger picture, or the weekly cycle is a bigger picture, and the daily cycle sort of feeds in for each day within the weekly cycle. So you can get a good bias for the week as well as a good bias for the day and sort of day's direction if you put the two together. And you know, this is just sort of without even looking at higher time frame analysis, you know, top down analysis, and sort of, you know, looking at the market's higher time frame intention based upon liquidity and imbalance. So you know, these are sort of things we're going to get talking about later on. So yeah, cool. So this is a good example of the bearish week. We're now going to cover a bullish example. Cool. So let's talk about a bullish example of the weekly cycle. So got a nice example here on the chart. So let's break it down into its characteristics. So it's slightly different to a bearish week. So just like on the bearish week, obviously on a Monday, the market sort of starts off in a liquidity deficit, which, as we explained earlier, you know, that means the market, you know, is low on liquidity. Typically, we'll need to sort of harvest some liquidity to sort of fuel the beginning of the week and to begin to establish the weekly direction. So, you know, Monday's going to sort of have fairly low price movement. It's not going to go crazy. It ain't going to be like Thursday, etc., Thursday and Friday, where we have these big expansion moves. However, on a bullish week, we could expect Monday to take liquidity, to sort of gather, you know, capital to sort of move the market at the beginning of the week. So expect some type of draw on liquidity on Monday. In this example, you can see we have a nice draw on liquidity here. A very nice rejective candle, sort of confirming that as a draw on liquidity. This low likely to be a protected low. So quite important about a bullish example is that Monday will typically create the low of the week. So in the bearish example, Tuesday had the manipulation move and will form the high of the week, whereas on a bullish example, Monday will sort of form the low of the week, and this low is protected throughout, you know, Tuesday, Wednesday, Thursday, and Friday. So, you know, the sort of main characteristics of Monday, it will sort of have fairly low momentum, build liquidity on both sides, and you know, it will like to take liquidity to sort of begin fueling the market for the next current days. We can see that Monday creates a very nice trap zone here. You can see there's a lot of liquidity above this high here, as well as, you know, sort of leave a nice liquidity in the form of a trend line over here. So looking at Tuesday, so just to start off, we can see we've had a nice money transfer which occurs inside of here. we're going to get on to talking about this sort of stuff deeper on throughout the bootcamp call. But we have a nice money transfer which occurs here. Monday is the protected low of the week. And so the characteristics of Tuesday is essentially going to establish the direction of the week. So, once we start to begin to break structure upwards above Monday's high, and sort of trade back into levels and continue up, this is Tuesday sort of establishing that the week is going to be bullish. So Tuesday is still going to be not crazy high momentum, but definitely higher than Monday usually. But it's essentially going to sort of accumulate liquidity and take it out, and begin to sort of move in the direction of the week's sort of bias, if that makes sense. We can see Tuesday here, generating liquidity, pushing up, breaking structure above Monday's high, taking liquidity, confirming that with a nice rejective candle, and beginning to move away, and continue that bullish structure to sort of break structure upwards again. Wednesday will typically have a lot higher momentum than Monday and Tuesday. Wednesday usually will build the highest amount of liquidity on both sides of the market. This is typically because Thursday will then have a manipulation move, which will usually have high momentum. So in this example, we can see Wednesday builds a lot of liquidity above both these news high and lows. So we have tons of orders above here, and a key thing to the algorithm, it likes to build liquidity on both sides of the market. It likes to liquidate one and trade towards the other. So just like we've seen many times with the Asia range, the sort of Frankfurt range getting taken, we're going to see it with the market maker buy to sell models, and as well as sort of in the weekly cycle as we talk about here. So we can see that Wednesday has generated large amounts of liquidity on both sides of the market. And Thursday is the manipulation move. So Thursday will manipulate either, a high or low of Wednesday. Obviously, because we're expecting a bullish week, we're expecting, we could expect the high to go. However, potentially Thursday could liquidate down and then continue up. But usually the manipulation move caused on Thursday will be bullish, a bullish move. So you're expecting a bullish week, and this feeds in well with what Friday does, since Friday will usually distribute and then reverse the market. So on Thursday, we expect that sort of manipulation, that bullish move, and you can see within this example, the sort of intention for Thursday to sort of inject a large amount of capital is obviously one, to take out Wednesday's high, but two, for this higher time frame liquidity level. You can see we have a nice draw on liquidity here. Price cleanly draws liquidity. We then start to shift and have that money transfer where the liquidity taken out above this high gets transferred from weak to strong hands. So the algorithm essentially captures the sort of weak traders who got liquidated here. That money is transferred from the weak traders into the hands of the algorithm here, and this high is sort of respected as the high in which the sort of transaction has occurred, where money has been sort of transferred between both parties, and then once this happened, the algorithm is sort of happy to continue to re-inject the capital taken above this high into the market to push it into its next chosen direction, which leads perfectly on to Friday, which like we said, Friday will usually distribute the market and continue to the opposite direction of the bullish week, so essentially reverse the market. So you can see we have a nice distribution here. We come to respect the money transfer level up here, and price holds and continues down, with quite a lot of momentum, reversing both Thursday's liquidity and the key level we talked about earlier, which was Wednesday's low. Just as we discussed, the market likes to build liquidity on both sides and then continue down to take it out in future time. So the week will sort of end there. Monday still being respected as the low of the week, and the week being bullish. The Monday to sort of come from here is at a sort of well-priced level when we talk about it in terms of the whole week. So from this low to this high, we're definitely sort of in the discounted area of the week. So we're at a nice well-priced level where we've, taken liquidity. And depending on higher time frame bias, we could be ready for, another potential bullish week, or potentially a bearish week where we could see Monday range, Tuesday liquidate and have a bearish, sort of a bullish liquidation, continue bearish, Wednesday to sort of continue, Thursday to accumulate and continue, and Friday to push up and form the low of the week. And this is sort of how the weekly cycle plays hand in hand, and it's perfect. So it's definitely worth studying, incorporate within your trading. Keep an eye on it for your higher time frame sort of top down analysis. Just like everything, the market is a snowflake, it's fractal. Nothing's always going to play perfectly, but this is sort of high probability theory to what a usual week will do and the usual sort of characteristics of each day. So keep in mind where you are in the market, and also where you are in terms of time of day, sessions, daily cycle, weekly cycle, etc. That'll be a very big handy point. So we've kind of gone over cycles and sessions now. So next we're going to begin to get onto some of the juicy bits, which are like the proper technicals. Begin talking about algo structure, a lot on liquidity and inefficient and efficient price action, algorithmic candles, types of mitigation, traps, etc. So take a short break if you've been sort of watching this continuously. Recalibrate, go get a drink, go get some coffee, come back another day, take your notes, go over your notes, etc. Make sure it's all in the head, and then we can continue on. So we're going to be talking about liquidity now. So obviously there's quite a chunky bit to get through. Liquidity is obviously the most important aspect of the market in my trading, or if not one of the most important. And there's many forms of liquidity which we sort of use and we need to know about. And obviously the most important thing to know is which liquidity points are more important and likely to sort of play than others, to essentially help you take more winning trades and sort of getting involved in the market at better priced areas for sort of the long term, for swing moves, stuff like that. These really high probability, sort of higher time frame, directional sort of trades. We've got to talk about algo structure, which is essentially the way to derive how the market moves in its most common sort of format. Inducement. We're going to talk about inducement. We're going to talk about internal range liquidity, which is slightly different. And obviously we're going to be talking about the most common form of liquidity, which is structural liquidity and liquidity voids. So probably best to sort of get some definitions, and sort of look into what actually is liquidity. So I think I discussed this at the beginning of the recording, but essentially a way that will sort of make it easy to sort of remember and learn. Let's write it out just to sort of get it down. So liquidity is data. So the algorithm will view all liquidity as data. What do we actually mean by data? Well, data equals orders. So liquidity is just data, and data is orders and transactions which exist in the market at a specific magnitude of orders. So a certain amount of capital at a certain price level, and the algorithm views liquidity as data, since it uses mathematical calculations and AI to sort of base its movement off of. As we discussed, the algorithm doesn't know what a chart looks like. The algorithm doesn't know highs and lows or structure. It just knows data in the sense of at a certain liquidity point, there's a certain amount of orders, and at another sort of price level, there's a different amount of orders. and obviously essentially some liquidity is more important than others. Well, that's going to be the areas where there's going to be higher amounts of data that exist at that point, or higher magnitude of orders that exist at a point compared to the other. And in terms of sort of imbalance and rebalance in the market, when you have two separate liquidity points, say we have a market movement of this much, so the market is dropped by this much, we will have liquidity, all transactions all the way, loads and loads, millions, trillions, billions of USD of capital just all the way throughout every single sort of price of leg, throughout every single time frame, from the market's fractal, of course, so throughout every single time frame there's orders and transactions occurring. Each candle can be seen as its own individual sort of time frame of transactions, and we can derive imbalance from differences in amount, differences in the magnitude of transactions. So for example, in this amount of price movement, this volume of price movement, say we have a block of transactions this big here, and then we have some blocks of transactions like this. We can see that we have significant liquidity at these points, and within here is essentially an imbalance, which price can be drawn to sort of take out liquidity and to mitigate more liquidity points, which it's a sort of just an easier way to break it down from an algorithmic perspective, and what the algorithm will see compared to what we actually see. Obviously this would be then reflected onto a chart, and we would see actual price movement where we will see significantly more liquidity at these areas, and less liquidity areas such like this. Obviously we're going to go very much in depth into all this, look at the chart and stuff, but I just wanted to give a sort of short diagram into this. So yeah, as we stated earlier, the three main types of liquidity: structural liquidity and voids, and sort of algo structure, which is the main essential ways the market moves. And then we've got inducement, which is a way in which we can sort of get involved. We're going to look at inducement by definition, and then get into the sort of chart details of it and how to trade it, and also how it's one of the most high probability ways to sort of take trades, and base your analysis off. And then finally, internal range liquidity, which is slightly different, slightly less common and less used, but high probability in a sense, but of course in certain market conditions. So we're going to look at sort of conditions of the market in which sort of liquidity points you want to be using at certain times. So essentially, let's hop into some algo structure. So what actually is algo structure? So obviously we know the algorithm doesn't view structure. The algorithm doesn't see price. A chart is just a graphical way to represent data. The algorithm doesn't see this. The algorithm sees orders at specific price levels. It sees numbers. The way that sort of general structure can be mapped could look like this. A series of high lows, high highs. This is how sort of people deem bullish and bearish structure. But in terms of an algorithmic perspective, we know that the market moves and operates based upon liquidity. And where does liquidity exist? Well, the first place we're going to learn that liquidity exists is the most obvious, literally, above and below every single structural point. Obviously, the higher time frame the structure, the more important. So, higher time frame structure is going to store more liquidity than sort of this internal liquidity. And this is where we're going to talk about when you play sort of algo structure compared to internal range liquidity. Like for example, why would you not take a buy off of this low instead of taking a buy off of some internal liquidity in here? We're going to talk about all this stuff and how to know when to use each one. But essentially, let's map some algo structure. So this is when price liquidates. It doesn't form perfect structural highs and lows as the market sort of, or people teach and trade these perfect sets of sort of highs and lows in the market. Algo structure is the movement of price action like this, where highs and lows are liquidated. However, the sort of trend remains the same. So in a bearish market, obviously the trend remains bearish, but to sort of harvest liquidity to continue the price movement, price will move in a specific way like this, where liquidating these highs to continue the market down to the next sort of draw on liquidity in that trend. So in this case would be this low. So we take a high, this high gives fuel to continue, push the market down, build up some more liquidity, come back, reprice into this level, continue down, come back up, take out more liquidity, continue down. And obviously it's the same for bullish structure. We have liquidations on different price movements where these are the sort of positions that we want to be entered in the market to trade. We don't want to be trading, we don't want to be looking at every single order block like this. We don't want to do that because you will get liquidated. If in a sense of high probability trading, you don't want to be having all these striped pajama sort of order blocks over your chart. You want to know, how do I sort of identify the high probability levels in terms of liquidity and algo structure to sort of continue on, and have this high confidence in your sort of trades that the market or the algorithm has harvested enough liquidity to be able to continue driving the market to the next draw on liquidity and eventually, higher time frame levels that, you should always have a bias around and a reason why you're sort of taking a trade. And that should be based around higher time frame liquidity, which we're going to be talking about top-down analysis later on anyways. Let's just go and have a little look on some charts and sort of identify this in a live market. So just looking at some markings on EU, which we have, we can see how these swing positions, these high probability swing positions, which these are the areas we want to be sort of getting involved in. They always come from very strong liquidations. So the market building liquidity, with the set of equal highs. So in terms of mapping structure, we have high, a low, high, a low, high, a low, high, and this high obviously takes out liquidity, comes to mitigate a more high probability zone. So instead of looking at zones like this, we're using liquidity to our advantage. Price trades up to this zone, we get a very nice rejection. No candle body closes above the liquidity or inside the zone. So we've rejected this level and we could perhaps enter inside of lower time frame confirmation inside of here, since we've had sort of candlestick pattern confirmation of a rejection of this level, and trade this down to the next draw on liquidity, which is the low. You can see this is an example of price playing inducement. We're going to get on to talking about inducement later on and how to sort of position yourself on these levels using inducement, instead of sort of paying attention to all of this internal range liquidity bullshit, which are essentially going to give you little to no reaction. You need to know the points in the market where you're going to sort of see the market reprice to and continue down from. If your bias is for the market to go down, and we have now shifted bullish, or we've had a money transfer off of this level, perhaps we've hit a higher time frame level, we could expect the market to reprice back bullish again, start pushing bullish to come into areas to sell from. If you know that your high probability area you are looking to sell from is this level, then all of this should not interest you. You should be solely interested in buys until we get to here. And once we're here, we can then look to sell down to our next liquidity point. Just like here, how market leaves behind supply zones. But since these supply zones have no liquidity, when we map structure correctly, right, get the highlighter. When we're looking at in terms of structure, a high, a low, a high, a low, a high, a low, a high, low, bang, 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 bang. You know, we're following this algorithmic pattern where we are getting positioned in the market in these levels where price is taking out consecutive highs and using that as fuel to come and deliver down to the next liquidity point. You can see this happening, you know, again here, for example. On every pullback, as the sort of market is traveling in its desired direction, highs are going to be liquidated, or obviously lows if you're taking buys. These are the areas where we want to be interested in taking trades. Where consecutive highs and liquidity points are being taken out, and structures essentially being disobeyed, areas are being swept and then rejected from. These are likely areas to sort of want to take trades from. When we look at, say, this exact area of price action here, so we have this push down in the market. Let me get rid of these indicators real quick. We have this push down in the market, this whole leg of price. We see that around the EQ of this point, so around the midpoint of this range, we have this subsequent liquidity. Price comes in, sweeps above the liquidity, we get this rejection, and we continue down. The market doesn't play supply zones like this because the market operates on liquidity, and there's no liquidity inside of here. The nearest liquidity point is this high here. So the market isn't going to be interested in playing this level. The market is going to want to come in, fake it out probably, and continue down. But, you know, the main idea is that the market is going to want to use this as liquidity to continue down. Just like here. The market moving based off of liquidity, etc. You know, this happens on all time frames. You can look at it all the way through. You know, it's a fractal sort of concept. You know, the market moves the same throughout every single time frame. So, you know, the 1M structure, 1M algo structure, 5M algo structure, daily, 4 hour, 1 hour, 15M, monthly, weekly, everything. It's all going to be the same. You know, these are where you get your high probability entries, where you want to be getting involved off of these structural liquidations, where we have, you know, highs, lows, bang, liquidity being taken, and we continue. Structure being violated, you know, SMC traders view this as what? Change of character, potential, you know, potentially the market showing intent to shift bearish. They may be looking at supply zones. The market continues to push, whereas actually this was just a grab of inducement coming into a deeper level, taking liquidity. The market takes liquidity. It uses the liquidity in here, which is what we call the money transfer. We're going to talk deeper on into this, but essentially the money, the data, the orders that exist here get liquidated, transferred inside of here. You know, they're transferred into the hands of the algorithm. The algorithm uses it to continue to push the market into its desired higher time frame direction, higher time frame liquidity, etc. One thing to keep in mind is that every significant liquidity point in the market is capable of causing a expansion or retracement in price action. Every sensitive level has the potential to cause pullbacks and continuation trades throughout the day in terms of structure. The potential to cause bullish moves. We have higher time frame level, which could be potential to cause bearish move, then continue up. Something to be wary of. Obviously, we're not trying to ping pong every single trade. That's, it's stupid. It's not necessary. But what we do want to do is get involved in the high probability, well-priced levels, these swing levels, intraday levels where you can sort of ride the market throughout its daily flow, getting involved in a strict area, having high RR potential, but also maintaining, that high probability entry, using liquidity, time, and other confluences we're going to talk about, to give you sort of essentially the best chances to capitalize in the market. So we've dug a little bit into algo structure there. There's, obviously we're going to talk about inducement next. Aside from inducement, then we've got internal range liquidity. Then we're going to be talking about sort of a different type of liquidity, which isn't essentially, the way you'd view. So instead of looking at the market in terms of liquidity and where to get involved, we're going to be looking at, your more sort of general liquidity in terms of more frequent manipulations. So essentially, instead of like diving into algo structure, we're going to be looking at what is actually going on inside of levels, such as, market maker models, liquidations, fake breaks of structure, so fake structure, fake breaks, fake changes of characters, things like vector candles, retail traps, stuff like that. So let's get talking about inducement. So the first thing to talk about with inducement is, it's always good to establish the word by definition first of all. So let's actually look at inducement in the real world. What does the actual word mean? Aside from trading, it obviously has the same meaning. But, from a Google search on inducement is a thing that persuades or leads someone to do something, or a type of bribe, some type of encouragement, some incentive, temptation, or some sort of attraction. You can see similar words there. Something that sort of encourages someone to do something. So obviously, in terms of a market, inducement, the word inducement in a market is a sort of market condition where someone is incentivized or inclined to sort of enter a trade, a buy or a sell, due to certain price movements. So someone could be induced to take a sell off of this level. However, they are encouraged to sell, or they're inclined to sell off this level. However, we view them as inducement, type of early sort of liquidity, which gets taken, and then the price continues down. So when we are looking at playing our levels in a sort of scenario like this level here would be inducement. Why? Because traders are incentivized to take a trade off of this level, this supply zone. So this supply is what they will sort of view as the level which caused a break in structure. So they would sort of, be inclined to choose this as the level to sort of take their sell from, their supply zone. However, us taking advantage of the information gap, we are interested in selling off of this level here due to this being classed as inducement, and having an understanding that the market needs to take liquidity to continue down. When we have this pullback into price, this mitigation gets liquidated, Price takes out the inducement, and we continue to our next point of liquidity and towards our higher time frame target. So this is what we would call inducement. Liquidity before our POI. So before our level, we need to see liquidity. And this liquidity needs to exist in the structure, in the range, in the push down. You know, we wouldn't classify this. We're not calling like this inducement here, because this isn't inducing anyone to sell. The actual zone itself is what is inducing people to get involved into sells. However, we are interested in this level because of this. We want to see this price level here being liquidated before we get involved. So we know that traders have been taken out before we get involved. And, you know, that's the most important thing. We want to be positioning ourselves in the market where we know other people have been taken out before us. We want to know that other people have been taken out early. You know, if you can't see the liquidity, you are the liquidity. You can't see people getting taken out before you, and you're about to get taken out. That's the sort of term you need to sort of become familiar with. If you can't see the liquidity before you, then you are the liquidity. Cool. There's also other ways which traders may be inclined to get involved, not just smart move traders. We also have our good old support and resistance traders, in a sense. You may be getting involved off of this level here, which we've had here, here, and here, getting into sells. You know, maybe we have other levels like this, whereas we are more inclined to take this level up here due to the nature of it. So yes, there is other types of inducement. There's a type of inducement which can happen, which, you know, doesn't occur inside of this range. We're going to dive into this deeper, but I'm just going to drop it real quick, just very briefly. Essentially, fake movement. So say traders were looking at this as a zone, you know, this would also be a type of inducement. Why? Because we've had this fake movement, you know, we've had a fake break of structure. So if, you know, we've had a break of structure downwards, which may then encourage traders to take sells, look to take sells, since they are under the assumption the market is now shifted in trend. But us, you know, we don't use structure, we use liquidity, and we are aware that no significant liquidity has been taken. Therefore, this must be the liquidity. So when traders sell here, they are liquidated. We're getting involved here, knowing that, you know, have we had a liquidation before our entry? Well, inducement, and we know that traders have been involved here and been taken out. You know, we have now this nice build up of liquidity, and we've got our nice higher time frame liquidity points target down below. So it's a nice little bit of information around inducement. When we actually look at this back on EU again, just where we were looking on a minute ago, we can see it's gone to a nice time frame. So let's have a look. Let's have a look here. So this level here is less likely to play than this level up above here, because this level has significant liquidity for the market to take out. We have, you know, a high amount of liquidity for the market to take. We have a protected high because this high takes liquidity inside of here. Price comes up, do a little diagram on this. So we have high, which gets swept, have this liquidity, and then we have a bunch of just shit going on here. Price is inclined to this level due to the liquidity that exists here. Price subsequently builds liquidity to target, and once price delivers to the level, it continues down and eventually takes out its next point, which is the low. This level leaves behind another zone here. Why is this a trap? So when you study this, there is not any significant liquidity. No liquidity. It's simply a push down. Nothing in here. So we can expect this to be taken. So then continue down. So this high, since there is no liquidity that exists in here, this high is the liquidity. So we would be looking at this zone here. Here we go. We have our fake breaker structure, fake chalk, as we were talking about earlier. That's sitting in there, hiding. There you go. It's nice fake bars. You know, it's fake push down, getting traders involved off of this big supply. Up time frame a little bit. There you go. Getting them final traders involved off of this level here. They get liquidated. Price takes the liquidity and eventually continues down and delivers off of this level. There you go. Same thing happens again. This level here does not have a huge amount of liquidity that exists here. You may argue that level here is valid liquidity. However, for inducement, we are more inclined to immediate inducement. So what does the word immediate mean? Well, we want the liquidity to be immediate to the level. So it needs to be close by. It needs to be very relative. So, for example, for example, this level here, the liquidity is immediate because it's very close by. So as soon as the liquidity is taken, the market can mitigate its level and continue down. Whereas within here, the liquidity is very far away. There's no immediate level. Whereas when you then look at this high as being and refine this level, this refined candle here, which has this immediate liquidity here. So when price comes up, it can mitigate and take liquidity. We have that aggressive reaction. The price to then continue down to its next liquidity point. Beautiful. Entries as well. You know, there's other entries that you could get involved in. Side of here using literally the same theory we've just been talking about with inducement and algo structure. The market builds liquidity on both sides. It's always important to remember builds liquidity on both sides, takes out one side, and then continues to the other. We take out one point, we take it out here, we continue to take out more, we build liquidity, and we continue to take it out. We take liquidity, we build liquidity, it gets swept here, comes back to mitigate, and we take it all out. Essentially, as a result, get down to our desired level. So it's a nice little touch on inducement. Obviously, we're going to be seeing this a lot throughout this recording. A lot of our trades, well, every single trade is going to use liquidity. Inducement, not every single one's going to use inducement, but 90% of them, inducement, algo structure. Essentially, this is the most highly probable ways to get, a good pricing, a good fill, good entry in the market. So yeah, that's a nice little touch on there. Next, we're going to be talking about internal range liquidity, and then we're going to get more into sort of early manipulation types, such as the fake break structure, fake change character, which is the same thing, market maker models, etc. I'm going to touch a little bit on how to use fixed range volume tool to sort of identify which liquidity points have more than others. And yeah, always remember, guys, price does not need structure to move. Price needs liquidity to move. The algorithm does not need highs and lows. The algorithm does not move the market with intention of forming highs and lows. It moves the market from one liquidity point to the next. It has to move up and down. The market cannot move like this. It has to move like this. It has to go up and down. It can't move just in a straight line. Why? Because if the market moves in a straight line, what would incline anyone to take a sell? There's nothing to incentivize people to take sells. We need movement like this, so the market can reprice to fair value. We can get fair pricing, which people are happy to take sells. They are also happy to take buys. And once the market builds liquidity on both sides, manipulates one, manipulates the next. The market moves up and down, and it has to take lows, it has to take liquidity, it has to move into fair pricing to allow both sides of the party to be happy to enter and get involved in the market to generate more liquidity and accumulate more orders, which can then be taken out and harvested to then move and deliver price to its next higher time frame, directional bias, or desired level. Right, guys, so now we're going to be talking about internal range liquidity. So we spoke about what algo structure and inducement are. Next on the agenda is internal range liquidity. So there is a specific sort of times we'd use this to sort of trade the market. One of the characteristics is when there's high volume in the market. So I'm going to draw up a sort of example. So in a situation like this, the market leaves behind a high volumed imbalance, where sort of the nearest order block range would be up here. However, since this order block range doesn't have immediate liquidity, so there's no inducement here, we wouldn't expect price to necessarily come to mitigate this level, since price is likely to react off of the liquidity where the mitigation is sort of close by. So, we wouldn't expect price to reach this level to give us a sell, since there's no sort of immediate liquidity or like any inducement that exists beneath this zone. However, instead, we have this internal range liquidity, where this is our price dealing range. We're dealing with this sort of push bearish in the market. This is our high and this is our low. Within this push down, we have this internal liquidity, where above, we have no liquidity, and below we also have no liquidity. So this is our internal range. Usually this will sit around the sort of premium discount of the price range, so about the 50% level, which is where you're sort of be able to get higher probability plays. So, for example, selling at a premium price and buying at a more discount price. So we can see that this internal range liquidity here is around the 50% mark of this range. And obviously, since there's no liquidity close by, we're not expecting the price to come here. So what we can do simply instead is expect the price to just play off of this liquidity. So we will see price come and push this liquidity here, begin to react. And once we start to sort of confirm this level with a sort of aggressive, reaction off of it, once it's swept, we can begin to sort of take a sell in price. So this is how you can sort of play price. Well, when algo structure and inducement isn't present, so we're not in a scenario where we have this going on, where price is going to be sort of more sort of magnetized to come to a level like this, where we have price sweep liquidity, a strong rejection candle leaves behind inducement, which immediately gets taken out. Grabs liquidity. This is a high probability sort of entry area, but in a scenario where this isn't present, nor is sort of playing the swing level, so playing the algo structure movements off of, say, swing points like this high here, are part of a sort of higher time frame bearish algo structure. The internal range level is sort of gives you a way to get involved. Usually this could be paired with something to make it slightly more high probability. So we may not, in a sense, have an order block, since this order block dealing range is quite high and far away. However, keep an eye out for is potentially breakers or sort of higher time frame imbalance, which we're going to talk about imbalance and FVG sort of later on in the video. But however, just for an example like this, where we have this price range upwards here, essentially a buy to sell range, leaving behind this large buy to sell, and also between this range here we have this imbalance. So paired with this internal range liquidity is the fill of this sort of what would be a higher time frame imbalance in price. You could sort of look to pair internal range liquidity with that to sort of give a more sort of more confirmed level to be playing off, in a sense like that. So cool. So for an example, this particular price action here, where we've got this is our bearish price range from this high to this low. It's our sort of 4 hour bearish push. We see prices taking liquidity of this high, so we can sort of say this high is fairly strong. And when we talk in terms of places for sort of price to pull back to continue expanding to the downside, when we sort of up the time frame, we can see we have nice liquidity which exists here. And if you sort of mess with the time frames a little more, you can see that this liquidity could also be seen to be here too. And the actual nearest order block range is here. So as you can see, how price is sort of quite far away from this liquidity point. The order block is quite far away. For price to sweep this and also then to continue here is less likely to happen. So we could be interested to sort of more play the actual reaction off of the liquidity, because there's nothing like immediate to mitigate, unlike a inducement zone where we have order blocks and sort of liquidity paired together. In this case, price is more likely to react off of the liquidity due to this large distance between the liquidity and the order block. So keeping an eye on this level, we can also sort of see if this could be refined in a sense. So this is our liquidity, our free, or you could look at it as a 4-hour major liquidity point. And we can see a tiny volume imbalance here. Going to talk about this a bit deeper on later on, but a volume imbalance, which is essentially an FVG, so, or an imbalance in the market. So, for example, this is an imbalance in the market. So between the low of this candle here and the high of this candle here, this is an imbalance. This candle's low and this candle's high do not sort of mitigate each other. Whereas if you looked here, for example, this candle's low and this candle's high, which is here. You can see they both mitigate each other. So this is an imbalance. However, a volume imbalance is the same thing. However, no body is in the way. So we have just an imbalance in wicks. So no body candle. So 1 wick and 2 wick overlap each other. So we have an imbalance here. So we'll keep an eye on that level. And if you see this imbalance is paired perfectly with the actual liquidity point. So that can sort of justify why this could be a strong level. Price comes in to mitigate the level. Subsequently builds up a large amount of liquidity. This is important, and as we've sort of constantly cross-referred throughout the recording, that the market likes to build liquidity on both sides of the market. Intentionally, the market has built the liquidity here, come take out in future, and 2 has built a large amount of equal lows down here. So once price can deliver to this level, grab liquidity here, it can continue down to take liquidity, and that liquidity here will fuel a more bearish push in the market sort of desired direction to the downside, subsequent to the higher time frame trend and analysis, which we're going to talk about top down and so on later on. There you go. Price eventually pushes down and continues. And when you look at this specific price leg here, what do we have here? We have a new bearish range created, or currently, when we look just down below here. Let's go here. So we've got this bearish range created. This high to this low. And what specifically is this range lacking? It lacks sort of any range of candles in it. It's very high volume. We have this very high volume push down. Little price action inside of here, just a large sort of void of liquidity and imbalance within this big push down. So there's no actual liquidity the market would be sort of attracted to take within here. If the market was to push higher, we could potentially look at a zone like this, which we would call an order block with inducement, as this is our level and we have immediate liquidity. Immediate meaning it's very close. So as price takes the liquidity, it mitigates the level at the same time, and we can continue down. This is a very strong liquidity point due to the large injection of capital which got pushed into the market at this time to it cause this push down and sort of break structure here. We can tell that at this level, the majority of smart money traders would be interested at taking sells here. Why? Because they would see this as an attractive POI because it's broken structure. We've had a BOS and it's very high volume. It's very bearish. This is the candle which caused this break of structure. However, we would view this candle as a sort of trap candle or liquidity candle, knowing there's a lot of liquidity resting above this. So we'd be more inclined to look at a POI like this. However, depending on the higher time frame, we may sort of be wanting to see price, essentially take out this level here, because apparently, a part of a higher time frame play, price may want to come into this level, potentially fill some imbalance, take this sort of 8-hour or 12-hour, or by the looks of it, maybe a daily swing higher, and continue down. However, when we drop down to the price action occurring inside of here, since we have no volume in here, the other sort of closest liquidity point we do have is this internal range high. So this is our internal range liquidity, as we discussed. There's no liquidity inside of here. However, we have this internal range of price action which exists here. So this is essentially our build-up of liquidity. We could wait for price to take this out and to continue to play down. Just like as we've previously discussed, the market likes to build liquidity on both sides of the market, just like how we built these equals here. You can see price is beautifully engineered more liquidity for the future down here currently. And what could we pair this with? Well, let's hop on the higher time frame. This range, so essentially you could look at this whole higher time frame range is a massive buy to sell range. And this is our internal range of liquidity. So we can see that actually this white gap here is an imbalance, a very, very high time frame imbalance. Very, very high time frame. And as you can see it sort of gives you a hint here, plays out the next candle. This gets filled and continues down. So let's drop down to the lower time frame. There you go. So play this out. So price takes the internal liquidity, comes to fill this range and mitigate this breaker block. We're going to discuss breaker blocks in more depth, but if you're aware of them already, then you can clearly see this is a mitigation of a breaker with a sweep of internal range liquidity. And once this happens, we get a very aggressive reaction of a price, which is what we have for our confirmation for this to hold as a level and to continue down. That price is rejected very aggressively, which is sort of confirming the strength of this level for a sell. And subsequently, sort of price pushes on from there. You may have potentially been able to get involved in here. I'm not sure how long. Okay, cool. So we can see here, we have our grab on liquidity, mitigation of our breaker. We have a very aggressive move in. I'm going to touch on this in more detail later, but essentially an aggressive move into a POI usually will signify an aggressive move coming out of the POI. This particular movement we can call a vector candle. We're going to talk about this later on. We can see price has built liquidity here. Also built trend line liquidity. So we know liquidity is in our favor for price to continue to deliver. We've taken liquidity and we're going to trade the market down to target the next potential draw on liquidity. And we could be a seller within lower time frame confirmation. See price has a nice sweep of lower time frame liquidity there. Once we dive into the entry models, we'll be able to see very clearly how we can get involved into trades like this. However, a trade like this would be very much necessary and high probability, a good position, a good way to sort of get positioned in the market to sell down and continue that sort of bearish direction for this particular day and in line with the higher time frame too. So that's a very good example there. So we spoke a decent amount on internal range liquidity there. We're going to cut it here. Next on liquidity, we're going to talk about early liquidity manipulations. So a type of inducement where people get involved in the market too early prior to sort of the POIs that we as algorithmic traders are looking into. So the POIs we're looking at, we want to see traders get manipulated before it hits some levels. We want to witness to see people get taken out before us. And if you can't see the liquidity, then you are the liquidity. So once we cover early liquidations, early liquidity models such as the market maker model, fake breaks of structure, fake chalk, as structure is essentially not significant to determine the market's direction, since the market operates around liquidity. So fake breaks of structure and fake changes of character are very important liquidity models. We'll also talk about vector candles, some other sort of characteristics of price action, and then we'll go from there. Once we've sort of covered parts on liquidity, we can dive into some IPA or imbalance, inefficient price action, and why sort of imbalance and rebalancing the market is important and how it can be paired with liquidity. We've already touched on imbalance a part here, but we're going to talk on sort of how each candle represents essentially a sort of magnitude of data or orders or a set of transactions, and how the market needs to continually imbalance and rebalance to allow all types of traders with all types of emotion and strategy, both looking to buy and sell, allow all types of traders to be satisfied with getting involved in the market to sort of generate liquidity and then manipulate both sides and sort of continue in the algorithm's desired direction to do the same sort of cycle, but just on the higher time frame. So everything is a fractal. The lower time frame liquidity cycle will fall in line with the higher time frame, and sort of keep going higher and higher until the sort of daily, weekly charts, the more long-term sort of price movements. So we will get onto that, and then we've covered a decent chunk there. We're going to talk on a lot of sort of mitigation areas where price is likely to be drawn to continue down. We've talked about it in terms of liquidity, but in terms of sort of mitigation areas, we're going to talk about mitigation qualities on how price actually taps a certain zone and what it means, and what is a sort of rejective way to confirm price movement. Algorithmic candles, talk about some more traps such as structure traps and smart money traps. Talk about some other models and event-driven algorithms, other types of algorithms. Then we're going to hop on to talking about the entry model, going through a bunch of entries, sort of case studies, stuff like that. We're going to start talking about some types of trappings in the market. We're going to start off with the most simple one, which is the smart money trap. The smart money trap is essentially a fake supply or demand area in which smart money traders we would expect to be looking to enter either buy or sell positions. Being able to identify these areas it's beneficial to us to know where traders are likely to be getting involved. So we can use this in our analysis to know where we can expect traders to be getting manipulated and where there may be higher amounts of liquidity, to sort of make sure we're positioning ourselves at the most well-priced, high probability areas. So essentially, we're just going to outline a couple characteristics of a smart money trap. So smart money traps essentially will be levels or order blocks created where the market injects very high volume. That's the one main characteristic. So a very large sort of high volume injection into the market where underneath the low or above the high in which the order was injected, it's going to store a lot of liquidity. And the next characteristic to one of these zones would be it has no immediate liquidity, or as we call it, inducement. So what does this actually mean? Let's have a look. Let's draw a little diagram. So the market creating a order block, a very high volume move in the market in which we contain no liquidity inside of the leg, and it's a very sort of high volume move. So price is not sort of inclined to hold a level like this since there's no liquidity to actually take to continue using, to use and mitigate this level to push up. However, for price to sort of be able to fuel the move up, we're likely going to want to take liquidity, and since underneath a smart money trap, an area with large volume is going to contain lots of orders underneath this low, price is going to be contained to liquidate, to use it to continue up. Why do smart money traders like using these zones? Well, smart money trading teaches that high volume sort of S&D or high volume order blocks, or the order blocks which have the intention to cause a break of structure are the sort of highest probability ones to look at. However, we understand the market works on liquidity rather than supply and demand. There's three different entities in the market. There's buyers, there's sellers, and then there's the algorithm who's buying and selling everything at the same time, and perfectly manipulating price in a certain way to emotionally and technically manipulate traders to get involved into the market, build liquidity on both sides to then manipulate one side and trade towards the other to reach higher time frame desirable levels, all a part of the lower time frame and higher time frame liquidity cycle, which is fractal in nature as we have described. So one thing you could expect is when price does reach a level like this, you could see a fake reaction, which is just to try and induce more traders to get involved off of lower time frame confirmation levels, and then it will liquidate and continue. Take a look at the chart. They're extremely easy to identify. Got a couple here. We have a very large push, very high injection of liquidity, and obviously the small money trap is a fractal sort of characteristic of the market by nature. So no matter the time frame when these sort of levels play, they are respectable on each time frame. It's a fractal sort of concept. So we can see this push up, which leaves behind this order block here. So very high volume, and also contains no immediate liquidity. No liquidity inside of here. So we could expect this zone to not hold. And subsequently, as price does push down, what happens to price? Price comes to mitigate this level here to clear a range of internal liquidity. This low is strong since it sweeps strong liquidity. We have a rejection candle which confirms this as a sweep. No body close, just a wick rejecting the level. Price comes and trades into this level and continues to move off, giving potential buy opportunities. And as price originally pushed down here, we can see it left behind another trap. This trap level wide because inside of here, this push, we have no liquidity and it's very high volume. We know above this high is going to store a lot of liquidity. So the price is going to use this as its next target. So you can carefully see how the algorithm manipulates the market, allowing traders to sort of want to get involved early, getting swept out, come to mitigate the correct levels, moving away, and as so building its future liquidity points, continue up and liquidate, and allow price to continue moving. Why does a level like this hold? Well, we can see that this level here, this particular level, has immediate inducement. Takes strong liquidity and mitigates. It's a strong high which grabs liquidity, also known as an algo candle, which we're going to talk about shortly, in which price comes and forms lower time frame inch confirmation, where you could be involved as a seller inside of here. Price continues down to come and take out internal range liquidity, as we discussed earlier. Once again, why is this specific order block an interested point for the algorithm to deliver to use to propagate and move price in its desired direction, which is a part of the liquidity cycle? Because notice how this mitigation here also builds up higher time frame equal highs. So now price can trade back down into a more desired pricing level, allowing both sellers and buyers to get involved at a more fair price. Why is the market more fair priced? Because this is our price range. We've now traded back down into the equilibrium point. This is our high, this is our low, this is our 50%. Our 50% is where supply and demand are both equal. Both buyers in the market are happy to buy and sellers are both happy to sell at the same time. So significant liquidity gets generated when both sides of the transaction are happy to enter. Both buyers are happy and sellers are happy. That's when significant liquidity is generated. Price delivers to this specific level. Since this level has immediate liquidity, which gets swept, come to mitigate here. Price pushes up from there, coming to clear out higher time frame liquidity point, which was the equal highs. And continue playing. Even on a more fractal level here, we have a zone with high volume. Okay, I'm just checking I was actually recording. A zone with high volume, what we'd call a vector candle. No inducements stored within this pricing push. The algorithm is not inclined to come in to mitigate any of this to continue up, since there's no liquidity to harvest. For our next push, say the algorithm was wanting to come push up to clear higher time frame liquidity here. Well, if the algorithm wants to push this level, how does it get there? It needs to take liquidity to be able to get there. It's not going to react off this level because this level has no liquidity to take. So obviously it inclines traders to get involved off of this mitigation, which eventually fails. We can see how this level now gets swept and liquidated, and it could potentially be used by their algorithm to continue up, etc. Depends on higher time frame market conditions. Where does the market actually want to go? Cool. Let's have a look. So we're still keeping an eye on our liquidity point. Higher time frame liquidity. Our internal range liquidity gets cleared. Have a full clear of all internal liquidity, leaving behind a smart money trap again, which gets liquidated. Then we finally have price deliver to this higher time frame level, clears liquidity, and as it clears liquidity, leaves behind a trap, which can be used as a target point for the algorithm to deliver to in future time. So once we deliver to this higher time frame level off of this higher time frame, a daily sweep of liquidity, price wants to mitigate this daily sweep of liquidity and continue to reverse to harvest more liquidity on the other side. We've taken out a significant amount of sellers in the market above this daily high. So in response to this, the algorithm is going to use that as fuel to now come and attack the buyers. So price sells off of this level to come attack buyer liquidity in the form of this smart money trap and the smart money trap we spoke about earlier, which gets completely liquidated. And price can deliver it to its next sort of desired liquidity level. You can clearly see the market building liquidity on both sides of the market. It will liquidate one side. Side's been fully cleared, and we will keep all of this liquidity remained to take out on our next sort of liquidity cycle push. You can see more smart money traps being developed, being used as fuel. This level getting trapped here, being used to create a pullback, likely for price to come into a more well-priced level. Sweeping liquidity, may want to continue down, use this level. There we go, so this level plays because it has inducement. We get a mitigation here, which clears inducement. This is just going back to the algo structure, which we spoke about earlier, which price may want to feed into, continue pushing the market. It's how you can get involved in these sell positions within these high time frame levels or lower time frame, more intraday levels, following the high time frame liquidity narrative. Look at this. This liquidity gets cleared perfectly for price to continue. So, we've sort of discussed smart money traps in this sense. We've seen quite a few plays in the market. Spoken a little bit about liquidity here. How the market is just generally moving day to day based off of its liquidity. Nothing too crazy. Smart money traps are essentially very easy. Just remember the quote: if you can't see the liquidity, you are the liquidity. And think about the nature of the market. The areas with the most liquidity stored are going to be the most obvious and bait. So that's why you have to play it smart. Allow manipulation to happen before your entry, and then you can allow yourself to get in at a more well-priced, higher probability area to ride the market to its desired direction. So now we've discussed smart money traps. We're going to touch on market maker models. Essentially, we've discussed throughout this call already the essence of how the algorithm builds liquidity on both sides of the market, liquidates one, and continues to trade to the other. It's what we want the market to do. It creates the easiest conditions to sort of trade. What am I even doing? What am I looking for? Path. The most common form of a market maker model is a range, a consolidation in which both sellers are happy to get involved and also buyers are happy to get involved as well, off of levels, demand levels, and we've got sellers getting involved off of supply levels, support and resistance. Both market participants are interested in getting involved, high amounts of orders and liquidity being created. Price will liquidate one, usually very aggressively. Why does the market manipulate aggressively? This is something you need to take note of. Just think about it. The market wants to manipulate aggressively to allow zero time and zero latency for you to make a decision. It wants to punish. It's all an emotional mind game. The reason the algorithm exists is because 99% of the market are human traders. Human traders have emotion, which differs from an algorithm, a robot, AI, program. Humans have emotion, and emotion allows room for error and mistakes. So, the algorithm manipulates quickly, so you don't have time to consider your decisions. Before you know it, you're out. Maximum emotional damage. Once liquidity is taken, it will reverse straight back down to harvest the rest of the liquidity. Why is this the most effective way to do so? Because as price breaks out, since we've just ranged, now we've had a breakout, traders are like, we've broke out of this range bullish. That is signifying the strength of the market after both buyers and sellers battling, creating a stagnant price movement. Both buyers and sellers not sure who's in control. As it breaks out, traders are convinced that buyers are in control, and they may be looking to get involved in buy opportunities, which eventually fail, and the market comes down to clear this side of the liquidity too. So both parties get manipulated at once. So market maker buy to sell model is, of course, when the market ranges, it will buy to then sell. So it buys up, leaves behind a trap, and then sells down. And obviously then you've got the market maker sell to buy model. Oh shit. Market maker sell to buy model, which is obviously price selling off, leaving behind a trap, and then continuing up. Both parties being taken out. It's a pretty common model. It's essentially the most effective way for the market to generate liquidity in range format. Usually if price is just pushing up, traders are scared to buy because they don't want to be too late buying, but they're also too scared to sell because the market is just too bullish. It would feel unnatural to take a sell. in such a bullish market, whereas a range, lower volume trading, where we have this rangey price action, price unsure, like traders are both inclined to sell and buy at the same, like sell and buy, depends on who they are, what they're thinking. It's a highly formidable way to generate liquidity for the market to then be able to harvest and continue in its direction. So it's a little bit of a discussion around the market maker models. Next on the agenda, we have fake breaks of structure and fake changes of character. I'm going to talk about the vector candle too and news. I'm just going to quickly touch on the vector candle. Essentially, what a vector candle is. Vector has displacement and magnitude from the physics definition. A vector candle is essentially a price movement of high volume, which moves the market, or it has high displacement. So essentially, just like how we're looking at our smart money traps, we have these high volume pushes in the market. This sort of push up we can describe as a vector candle movement. I'm going to quickly pull up a little example from my data collection, actually, which I was doing prior to recording this. Just going to pull it up. This is just data on winning trades. For example, this here. Going to pull up paint. Cool. This example here, this green box here, we'd call a vector candle. As you can see, the market has built liquidity on both sides of the market, creating this range. Typically, after we have slow, rangy price action, we're going to get some large injection of capital. Most of the time, going to be a vector candle. Why? Because obviously, vector candles leave behind smart money traps. So I can understand that this price range here, this whole buy to sell, I can't draw a straight line. This whole sell to buy range here, causing this push up, likely going to fail. We know there's a lot of liquidity stored under here. But another important thing to know about the vector candle, this is touching on mitigation slightly, but an aggressive move into an area. So an aggressive move in, say a high time frame level, which we can see by this line up here. Trust me, there is a high time frame level. A high time, I think I've actually got another markup on there. Okay, there you go. So this is the high time frame level. You can see it's internal range liquidity. We've had this whole range of price action here. This whole range price here. This smart money trap here. This whole range of price gets liquidated with a vector candle. And the key thing to know about a vector candle is an aggressive push into a level usually is going to signify an aggressive push out of a level. So when price hits this large vector candle sort of movement into your area, it's likely going to signify a large movement out of your area to come and take this low out as future liquidity. Another thing to know about the smart money trap too, it's also more effective when it takes liquidity. So say, for example, let's get pen and paper out, have a little drawing. So when price has this large push up, we identify as even behind a trap. So if price pulls back to this level, say you're looking for sells in an example like this. Over here we have some sort of higher time frame liquidity. Maybe it's like some nice inducement, like so. We're like, right, we're looking for a sell here. Price pushes up with a nice vector candle. So an aggressive move in, we're expecting this aggressive move to probably come out of this zone. Since, once the market is pushing buys so heavily, retail traders are incentivized that the market is going to push. Higher time frame traders who see this as say a 4-hour breakout candle, 4-hour large bullish candle, could be setting buy orders like this with large stop losses. However, this is simply a fake push in the market, a fake buy order. Gives an aggressive push back down again. A fake buy up. This vector candle is a fake push, showing fake momentum, fake demand in the market to then continue down. So we hop back on here, we can see this aggressive move in, then we get these extremely aggressive candles out, come to deliver to our sell side liquidity target, which was this swing low, happened to also be beautiful equal lows. We know there's lots of liquidity stored here. When you actually, let's zoom out a little bit. When we look at this push here, we leave behind this zone. It's a trap because there's no liquidity. So price absolutely melts through and comes to hit our higher time frame level, which we could expect to see buys out of, etc. So I've touched on the vector candle, how to sort of use it. It's a very good example there. We get this very aggressive reaction, confirming that we are rejecting this high time frame liquidity point. Money's been taken. We're now looking to reject and take that money from this high back to the bottom side. So now we've took out sellers above this liquidity high. Took out the sellers above this liquidity high up here. We're now looking to transfer the liquidity from them sellers and use it to attack the buyers, which we then aggressively push down, liquidate lows, and eventually liquidate our higher time frame equal low sell side liquidity target, etc. So here's another example where we have the AMD, the accumulation, the manipulation, the distribution of orders. We build liquidity on both sides of the market. Liquidity is being built on both sides. One side gets liquidated. An aggressive move into our higher time frame liquidity signifies an aggressive move out. This leaves behind a smart money trap. So we know there's a lot of liquidity resting underneath this high momentum candle. So that gives us good sort of confirmation for a sell. We know we've got liquidity to target. We have our aggressive reaction confirming the strength of this level. We build trend line liquidity, so we've got even more trapping. It's very essential to, when it's the market, sort of build liquidity and have target liquidity. You want to be getting in, anticipating a run on liquidity. We see this final sweep of the last sellers in this supply zone above this high. Once we have this sweep, which is essentially a lower time frame sweep of inducement. So you can see by price here, we've pulled into this level up here. We've reacted off, we've came in, we've formed the high, we've pushed down again here. We've staggered back, and we've came and swept. So it's literally lower time frame inducement, which is one of our entry models, but we're going to talk about that later. It's where we can position ourselves for a sell to come target liquidity levels and higher time frame liquidity to TP at. Lovely. So we've touched on the vector candle, touched on small money trap, touched a bit on liquidity, tiny bit on entries, a bit on the liquidity cycle. We've touched a bunch of things there. Some gems in there. So make sure you definitely study, make notes, go back, rewatch all of this. If you don't, then you're stupid. You should do, because this recording is just me for hours talking. Here's a more lower time frame model. The vector push in, 2 push mitigation, lower time frame liquidity sweep, etc. We're gonna get onto all this. I need to stop getting carried away and talk about entries. We'll save all the juicy bits for later. We're gonna look at something slightly different currently. Going to take a look at the fixed range volume tool, which is just a sort of a trader view tool which you can use to sort of justify your levels a bit more. It's quite a interesting tool. I'm just going to quickly cover it. It's definitely something that can help you sort of train your eyes to spot the more important liquidity areas. So This is just a sell which I took today. We're just going to talk about how the fixed range volume tool can be used in this situation. So let's bar replay this back. Just back to here. And get rid of this. So you'll find it on TradingView. In here we've got a fixed range volume profile, and you want to use it by drawing it from the high to the low of your dealing range. So this high to this low. Identify your next higher time frame drawn liquidity. For me, it's this low here. So I'm looking for sells, and obviously the first low to go would be the low of the range. Looking to sell this zone. When we look at this volume profile, these bars will signify the magnitude of volume, or in other words, orders, which are sort of resting in an area. You can see that at this particular area, there's a high amount of volume. Obviously, this corresponds to this order block here. And we can see that, there's a bunch of equal highs here. So since there's a high volume of orders sitting here because of this level, we know that this is likely to get liquidated. And an interesting thing to note is you can see how in between here we have sort of high volume, and then we have quite a significantly lower volume area here. So essentially between here, between this level here, this line here, and within here, we've technically got like an imbalance between volume. You can see that here. You can see the imbalance in volume which exists here. So you can see that we've got a large large block of orders inside of here, which obviously corresponds to this order block, and then we've got a gap here. So price is likely to want to come sort of liquidate this liquidity in this volume range and come into this area, which is sort of an imbalance in volume, which obviously you can see this was like one of my first sell positions. The prior day was in here, and price came up the day after, and come and swept out this internal range liquidity high. So just like we were discussing previously, internal range liquidity came to sweep this level. When we actually draw the volume profile from the high to the low, so we can see obviously the volume range we were looking at got quite high block of orders. This area too has quite a high block of orders compared to the rest. So this is a sort of an area where we could expect a lot of liquidity. And obviously, does this correspond to our technical sort of chart analysis? Well, yeah, because this level corresponds to that 4-hour internal liquidity range high getting swept. So we can sort of confirm this is a key level. There isn't much more volume which exists unless price was to come and take this high. Price is unlikely to want to come here because there's little volume. It's likely just to liquidate this area and continue down. So obviously from my bias, my bias is to see sells within this range. So I'm not expecting the price to come take this high up here. So the next logical place, if price isn't trying to play off this level here, is to play off here, the next largest sort of block of orders, which price does. From there, we see our liquidation of the Asia range high, as we discussed at the start of the call. Have an algo candle. We're going to talk about this later, well, very soon actually. And then from there we get our confluences on lower time frame, which we'll discuss in depth later on. However, my sell position today was here. Off of this level here. TP1 at a potential area, which price may want to sort of retrace from. You got to think every significant liquidity point in the market is a potential area the market wants to sort of expand or continue from, pull back or an expansion. So TP1 at these sort of sensitive liquidity areas in case price is interested to sort of come into this range and clear this liquidity and give a reaction. I also stacked another sell inside of here too, and I also then stacked another one lower down, but I'm not going to talk about entries too much currently. We're going to talk about them later. But yeah, I just wanted to cover like the sort of fixed range volume stuff. It's quite a good tool to use. So let's get talking about support and resistance liquidity. So I'm sure everyone's aware of how retail predominantly trade using support and resistance theory. We can use this to our advantage in trading, viewing it as sort of liquidity and using it to justify the strength of levels and giving us trade opportunities to play off of the liquidations of them. Let's hop onto the chart and just take a look at some examples. It's a lot easier to view than talk about. So in this sort of current market condition here, we have this buy to sell range in price, and when you drop low onto the lower time frame, you can see we have these internal equal high liquidity points, sort of internal range liquidity by this OB range. Price forms this AMD model, so essentially the market maker model, and accumulation, manipulation, and the distribution of orders. So in terms of the liquidity cycle, the market builds liquidity on both sides. It will liquidate one and attack the other. So this is essentially the 5M liquidity cycle, where the market has built liquidity on the 5M on both sides of the market. It then will liquidate 5M liquidity, and then it give a 5M expansion down to clear the rest of the liquidity. So this here is one cycle in the liquidity cycle, and obviously the liquidity cycle is a fractal concept of the market. So essentially this 5M liquidity cycle here will all play inside of, say, a 15M or 1 hour higher time frame liquidity cycle, where we've had our higher time frame draw on liquidity. We come here, we reject, we begin to sell off to attack more liquidity. And then, once the 1 hour liquidity cycle is complete, this liquidity has all been cleared, the next liquidity cycle will commence, which could be essentially, once liquidity has been cleared, we come to clear, say, more liquidity, continue down, etc. This is sort of how the liquidity cycle works. It's like a magnet between liquidity to liquidity. And it all falls sort of in place. So the 5M liquidity cycle will act with the 15M, the 1 hour, 4 hour in mind. So it moves within each other. It's just a fractal way of the market moving. So sort of on the way to target a 1 hour liquidity point, you'll drop to the 5M, and within this 1 hour push to run liquidity, there will be 5M liquidity cycles, and then also 1M liquidity cycles too. So when we look at this OB range with internal liquidity, we've had this AMD. We understand that price is built liquidity, so it's liquidated one. So once we expect price to reach a sort of key level to play off of, we could expect sells to come and target this liquidity. We can also see that price has left behind a nice smart money trap. And going back to the smart money traps, why is it a trap? It's large volume and it has no inducement. got that nice big vector candle push up into this POI. Why is this a sort of interesting thing? Well, what we know about vector candles is an aggressive mitigation of the zone. We usually give an aggressive reaction. So this aggressive push in will usually give an aggressive push out. It's essentially a fake demand in the market. It's fake buyers, fake buying momentum in the market, getting, the RSI, the volume, the sort of RSI indicators, the strength indicator traders who operate around a sort of volume of buys and sells, getting involved on these buys after such a large, heavy movement. It's essentially just fake demand in the market. And yeah, going back to the main sort of concept in question is support and resistance. So why is this a sort of key POI? Well, we can clearly see that we've had this support level here, which is this low, all of these lows here, and we flip and turn into slight resistance on a lower time frame in here. So this is a key support or resistance level. So we know there's a lot of liquidity exists here, and retail traders may be inclined to be taking sells off of this point. And this aligns perfectly with our order block range and our lower time frame 5M liquidity inside of here. Price can liquidate this support resistance, mitigate this range to then continue bearish. When you follow it through, you can see this has had quite a few sort of. This is an interesting psychological level for the retail traders. Price is happy to come liquidate and mitigate our OB range. There we go, getting that final liquidation in there. Very nice. And coming down, mitigates the smart money trap, but fails to hold since it never breaks this high, so it never gives a clear break structure. So this SMT essentially fails. So there could be a perfect sell opportunity up here. This is a great sell because the setup is still valid. One, because the liquidity target, which is this AMD on the 5M liquidity cycle, these low, these equal lows of liquidity. And two, the smart money trap never got violated. So since we are expecting this level to fail, since it didn't fail, we're not expecting this smart money trap to hold, which means we're not expecting it to take the high. So if we're expecting it to not hold, we're expecting it to go, the market to continue and fail this level before it takes out this high. So somewhere within this low and this high, it's going to push up and then come down because we anticipate this low to fail. Hence why this sell position here is valid. Also could get involved on lower time frame confirmation with a sweep of liquidity. This is still valid. Why? Because we've still generated liquidity. You want to be getting in the trade when the liquidity is still generated. You don't want to be getting involved after we've started to sell here. After we've started to sell down and this liquidity is starting to be cleared, don't want to be getting involved. We want to be getting involved with anticipation of the liquidity to be taken out. Market beautiful trade. Always have a bigger stop loss too. Would be beautiful. Sort of a way you can use support and resistance in a trade example. Skip forward price a bit since it looks like I've got some support and resistance marked up in there. Cool. So same goes for this POI here. We have this order block range. It has valid liquidity. You may argue this inducement is not immediate. It's not exactly extremely close to the level. However, we have support and resistance for this inducement. So this makes this a very strong high, a very strong liquidity point, sorry, especially since it's a very reactive candle. So these high momentum candles will store more liquidity. So this is a high momentum candle. It's also acting as part of support and resistance liquidity. and causing a fake breaker structure. So we've called this fake bars down. And if you can remember when we talked about algorithmic structure earlier on in the video, this breaker structure can be seen as fake for price to liquidate. So these highs and lows don't have to hold. Price isn't going to form these perfect high lows, high lows. And people who trade structure then see this shift. They'll see this shift like this and be like, that's a change of character in the market, expecting the market to be now shifting bullish from bearish. However, this is simply just a repricing model by the algorithm. Take out liquidity and to continue down. As you can see, part of the liquidity cycle, the algorithm will build liquidity. You can see it's built liquidity, and it will take liquidity. So it takes liquidity, reprices to a well-priced level, this OB range, and then sells off to target this liquidity that exists here. We've also got this higher time frame support and resistance. Onto the 15M, we can see, get rid of this, all these consecutive highs. We have 1, 2, 3, 4, 5, 6, 7, 8. Why is this still valid in here? If you have a look, these candles here, the body holds the support and resistance, the wicks never break. So this is a very strong support and resistance level. There we go. Price hits us with that vector candle, as we've discussed, came across quite a few times. What does it do? It's the same AMD model. Price builds up this range. It's all part of the liquidity cycle. We build liquidity on both sides of the market. One side gets liquidated, we continue to the next. We mitigate a well-priced level, and we continue down to target the next liquidity. So we know under all of here, we have lots and lots of liquidity. We've perfectly engineered this. We liquidate, we mitigate into a well-priced area, and then we come back down to liquidate the other side of the market. We liquidate these perfect support and resistance liquidity points. We leave behind smart money trap demand zones. So these demand zones, which on the way down, smart money traders may see this very strong momentum with a break of structure. They may be interested in taking a buy from this level. Essentially may fail. Well, will fail, since it's a smart money trap. This is our liquidity cycle completion level, where we expect price to deliver to. Perfect. You can see this candle showing resistance from this level. Traders getting involved into buys on the 1M, and then failing. We deliver to the liquidity point, which was our target, and then our high time frame liquidity point, which could be this next low, and potentially even this low, and potentially this set of equal lows. And this set of equal lows is all a part of a higher time frame liquidity cycle, where we build liquidity, we come and liquidate, we build liquidity, we liquidate, we take out liquidity, we have a money transfer, and we come to liquidate. This is the liquidity cycle, guys. The market build liquidity on both sides of the market. We build liquidity, we liquidate one side here, and we trade to the next. Happens through every single time frame. There we go. So then price delivers to the liquidity point, and then also by the looks of it, even a higher time frame liquidity. Now we've delivered to higher time frame liquidity. The market will probably reverse in due time. So we've delivered to higher time frame liquidity. So now we need to attack the next part of the liquidity cycle. So looking at structure, turn this Asia range off, it's kind of annoying me. If you look at the algo structure, we have a low, a high, a low. This is the algo structure high, which gets liquidated. We have our build-up of liquidity. We have this fake move down. We're anticipating this high to go. We build equal highs. This push here is fake. Fake momentum for the market to get sellers involved. Getting people involved in these sells to buy up, to liquidate. The people selling here to also liquidate the equal highs here and then also liquidate this high time frame level. And we know we've took a lot of liquidity here. So we know we're going to get a big move. So because of all this engineering liquidity, we was able to take out this 4-hour and daily set of equal highs. So, you know, we've had a very large play on liquidity. Now we're coming to attack the next liquidity cycle, which is going to be more liquidity when we take a look at the algorithmic structure. High, low, low, high, low, bang. So we've got this, what? A low, a high, low, a high, a low. Getting liquidated. Structure being disobeyed. Likely we'll see sells from above this liquidity high. You can obviously look deeper into price and be like, what have we actually hit? So obviously we've cleared the liquidity necessary and we have filled this imbalance which exists in the market. Might as well touch an imbalance whilst we're here a tiny bit. This is an imbalance because this low, this high never mitigate each other. We have this gap in the market, this big hole in the market, which is a magnetized area for price to come to. So taking liquidity and filling imbalance, all are part of the liquidity cycle to come and target the next point of liquidity. Generating liquidity for the future above these highs. There we go, the market continues down to liquidate. These highs will become a future liquidity point somewhere along the line. All of these highs will become a significant liquidity point somewhere along the line. And the liquidity cycle continues. Building more liquidity, taking out more liquidity, etc. So I'm glad we've touched on that now. I'm going to move on to the next part of liquidity, talking about fake structure. So the biggest thing to note is that price does not require structure to move. Essentially using the trend or the direction, the formation of highs and lows to determine the direction of the market isn't necessarily the best way to trade it, simply because structure naturally exists through price movement. You know, for the algorithm to move price, it cannot just bump the market straight and then just reverse. Internally in movements, you're going to have highs and then lows and highs and lows and pullbacks and then expansions and more pullbacks and then expansions. Why is this a thing? We've already covered it slightly, but for the market to generate liquidity, both buyers and sellers need to be satisfied to take trades. So when we have an aggressive push up, a nice bullish leg, we will get a retracement. What is the purpose of this retracement? Well, to get more buyers involved at a more fair price. You know, they see price retrace, they're more inclined to take buys, and also to get sellers involved when they see the market start to reverse and start to go down. So both sellers are happy to get involved here, and also both buyers are happy to get involved too. So price will naturally move like this to generate liquidity. And this is why there is significant liquidity above every structural high and low. And that's why algo structural movement occurs, because above and below each high is significant liquidity. That's why we can take trades off of this structural liquidations. So the algorithm uses liquidity to move rather than structure. So when structure, you may see a structure shift like this. It may not be a change of character in the market. It could just be a liquidation to continue going. So we don't pay attention to structure. However, we pay attention to liquidity to move the market. One sort of main way liquidity can be generated is using structure. So, for example, prior to sort of a mitigation of a level we're sort of interested in. So, for example, this POI here on Euro USD, this order block has nice inducement, as we discussed earlier, very, very clean inducement. We could be looking to take buys from this level. We've got this whole trend being liquidated here. This level gets liquidated. Price starts to sell off. So when we have a look down on the lower time frame, we can see that price is now gave a change of character, a shift in structure where we've had a break higher and a pause to the upside. So when you mark out swing structure, we've now had this pause. This pause leaves behind this demand zone. However, we would identify this as a fake shock or a fake break of structure, since we are looking to sell this level. So this is a very strong confirm. So if we are looking to trade a certain level and we see a fake break structure, we know that this trader is looking to get involved into buys of this level. So as price can approach our POI, there you go, you can see traders getting involved in the buys here. Then we've got, the lower time frame traders getting involved off of S&Ds, mini sort of demand zones inside of here, looking to take price higher. And then price liquidates. So seeing this pattern occur before our POI is a strong confluence, since we've now witnessed structure traders seeing this as a shift in market structure, looking to take buys, and you can see them getting liquidated here. Also, in this particular example, it's also built up quite a lot of liquidity, resting for the market to leave behind to come collect. Let me get a move away. The market starts pushing up from this level. All right. So in this sort of example here, we can see price has sold off at a particular liquidity point. This may just look like a wick on the higher time frame, but however, you can tell that on the lower time frame, this is going to be inducement for this high. As you can see, we have nice liquidity and inducement inside of here. When we have a look at this POI, before price comes to mitigate, Just replay that. We see price begin to sell off early in the morning. We have this fake break of structure down. So the daily sort of, the market is opened with a break of structure downwards, sort of looking to sort of contradict this trend here. Potentially getting SMC traders involved into sells in London session at these levels. However, this is a fake break of structure. Another way to tell by this example is that Frankfurt high liquidity too. And a little gem, which I think I dropped earlier, is when Frankfurt high sweeps Asia high, it's usually going to get swept again. So you see Frankfurt pushes above Asia. However, Frankfurt will usually get swept again. So if the Frankfurt range takes out the Asia range, we can expect it to likely get one more push, especially in this example when it's paired with this liquidity level, or if you use the market, this S&D supply POI with inducement, which we're looking at. And from higher time frame structure, you could argue that structure is still bullish, still making highs and lows and structural sort of movements. SMC would argue that structure is still bullish until this low goes here, since this is the last structural low put in, and this low broke structure above this high. However, us algo traders, we can find ourselves best positioned in the market before the break structure actually occurs. So we're essentially anticipating this trend to break, not because, well, because we understand liquidity. We understand liquidity existing. We understand the run on this fake break structure paired with this higher time frame level and Frankfurt high liquidity, anticipating this level to get broken. And then from there, the market continues to sell off. And so on until we get a break of structure downwards. So when we actually draw this up into a sort of little diagram, so something to pay attention to. We have a fake break before the mitigation of the POI, builds up liquidity, essentially leaves behind a trap. And you can find yourself involved with lower time frame confirmation with the entry models we're going to discuss later on in the video. Well, the one entry model. Lovely stuff. The key thing to know, one sec guys, let me just text. Cool, sorry about that. So let's grab a POI. So another thing, another sort of thing small money traders find themselves, find difficult when trading is sometimes when the market breaks a structure or gives confirmation, the price is already moved in the direction they anticipated it to. So just sort of to understand how the market really doesn't require structure to move. Since a move away from this POI, we don't get a violation of structure. It remains bearish in a smart money sense. structure remains bearish. However, as algo traders, because we use liquidity, we don't need a break. We don't require this break in structure to signify momentum. However, we just use liquidity. We focus on what liquidity has been taken, well, how significant the liquidity is that has been taken, and how significant the liquidity is that's been built up. So we get a significant run on liquidity, a nice liquidity void. We're expecting price to deliver bullish. Say we have a higher time frame liquidity target that may exist up here somewhere. We build short-term liquidity for price to be attracted to, and we run liquidity in the opposite direction. Obviously, we trade away from the sweep. We sweep lower, so we want to buy and trade away from it. And we understand, price has generated significant liquidity. Structure never gets violated. However, this sort of level still plays as a beautiful buy, so we don't necessarily need structure. However, we may not need structure, but sometimes we will need momentum in the market, and that's when you can become involved in the market as such. An entry like this, where we have that momentum kick in, and we can get involved off of a breaker block setup, which we'll discuss later on. Obviously, there's lots of rules around this, but momentum over structure. So, say price comes to your level, and we have very sort of big push up like this here. So we react very aggressively. However, we don't get that break structure. That pause never happens. However, because price reacted very aggressively and kicked in momentum, we don't need this break structure, because this doesn't need to happen, because this is simply just built liquidity rather than breaking structure. Because if price had broke structure and then came down, this could have been a grab of liquidity. However, price doesn't break structure because it's trying to build liquidity here, which you can then get involved here on the lower time frame with anticipation of liquidity being taken out. Just a little bit on structure, structure traps. And so up guys, so now we're going to be talking about imbalance in the market. So imbalance is one of the most important concepts in the market. Essentially, what an imbalance is, it's the variance at a particular price level between the number or magnitude of buy orders compared to sell orders. So at a particular point or particular price level, there's a large difference between the amount of buys compared to the amount of sells, or the amount of demand compared to the amount of sells, vice versa, in the market. And this will occur when there is an excess of either buy or sell orders in the market at a specific time. So an important thing to know about imbalances are that they are temporary, which means the market will like to reprice back into these levels to allow both buyers and sellers to get involved at this price level. Why would this happen? Well, during a sort of movement of price where it leaves behind imbalance, since there's a sort of variation between the number of buys compared to sells, vice versa, only one party is sort of happy to get involved there. So obviously, when the market is pushing highly bullish, some traders are not wanting to buy because they feel like the price is too high or it's overbought, so they're not wanting to buy in. And obviously, some traders are also not wanting to sell because obviously the market is moving aggressively higher, so they're in fear of being sort of caught on the wrong side of the market and trading to counter trend. So once an imbalance is created, the market will likely reprice back into that imbalance. And this imbalance is deemed the sort of fair value. Some people know it as a fair value gap. So this fair valued area is where both buyers and sellers are happy to sort of transact in the market, which can allow for sort of the accumulation of orders, since if both buyers and sellers are happy to get involved, then obviously the sort of total liquidity in the market is going to increase at this point, which is good on behalf of the algo, since it can generate liquidity and then move price into its next desired level. So as sort of the market sentiment increases, so like we just discussed, once sort of more traders are looking to get involved, when market sentiment is high, the algorithm is likely to move the market with low resistance. So meaning that once prices sort of filled an imbalance and perhaps taken liquidity at the same time, which is the sort of most high probability way, the sentiment for traders to be looking to buy and sell is high, since the price of the security is deemed well priced. So liquidity can easily be built up for the algorithm to then sort of propel the market to its next likely chosen direction. So like I said as well, imbalances are best when they're paired with liquidity and also time. So this ensures that the market has taken sufficient liquidity to use the imbalance to propel to the next market desired level. And also the time of the day is important. Why? Because we need to be in sort of the London, New York kill zone to know that the move is sort of high probability for the algorithm to inject large amounts of capital, since these are the most active sort of trading hours during the day and when sort of market volatility and liquidity is highest. So we're likely to see the sort of highest and biggest moves within the daily cycle during these times. So it's a little bit of information around imbalance. Obviously, what does an imbalance look like on the chart? Well, a lot of people, I assume, already know what this is. If you've got this course, you're already likely very familiar with sort of this style of trading you're trying to look up. So we're not going to touch on it too much, but essentially, for example, an imbalance in this situation of candles would occur between the low of the bottom of this candle and the high at the top of this candle. So within here, all of this gap here would be our imbalance in the market. So, obviously, like this is likely to form when we get sort of high momentum moves. So for example, just like this, like between here and here, we've now left behind a big imbalance. And I'm also sure that, on the higher time frame, if you was to look at this as like a buy to sell range, then between this low here, this high here would also be an imbalance. Imbalance are likely areas for price to want to trade back into. So after this sort of push down like this, we understand that, price is going to want to reprice into this level before wanting to continue down. So since we've had this very bearish push, obviously it's not at a great it's not at a very well priced level. No one's looking to sell at the bottom here, and obviously traders aren't particularly interested in looking to buy since we've had a large move down. They're in fear of being caught on the wrong side of the market. However, if price was to return into the imbalance, it will start to begin to allow traders to think, maybe it's better to sell here, and traders can start to get involved into the market. Obviously, from an algorithmic perspective, we understand that there's no liquidity inside this imbalance. So, we wouldn't sort of want to look for a trade on the sell here. However, we can spot we have some resting equal highs here. So we have resting buy side liquidity above these highs up here, which price may sort of be looking to come into. And obviously during this, it can come to fill imbalance. And when we also look up here, so let's just get rid of this for the time being. So when we look here, this was the sort of one of the most recent sort of price movements down. We've had a leg of price come down. had price sort of retrace here. We've had price retrace here, continue down again, retrace back again, continue down. Obviously, following sort of a bearish trend. You can see sort of signs of algo structure where liquidity is being taken out. However, obviously, this high here didn't actually take any liquidity. So if we were to just look at this as like a low like this, well, this high hasn't actually took anything here. So because it hasn't taken any liquidity, it's likely to sort of become a trap in terms of algo structure. So the next retracement could take this high and continue down. So this would make sense since obviously we've had a push down, a push up, a push down, a push up. So what does that look like? A push down, push up, and push up. And then we've continued down again here. It'd be likely to sort of come and raise some liquidity to continue down again. So we can sort of overall follow that algo structure, which we've sort of spoke about throughout the session, where price will continue to trap highs and lows and continue sort of faking out shifts and breaks in structure sort of upwards when that actually just sort of grabs on liquidity for the market to continue down. When we actually have a look at this recent push down, we can see that price has sort of formed an imbalance. So we have this candle here and in here. So obviously there's two different ways price can fill an imbalance. I'm just gonna get rid of this for the time being. So price can fill an imbalance partially. So as you can see in this example here, price has only partially filled this imbalance since the market hasn't came and filled the whole thing. So technically you could argue that between here and here, we still have this imbalance here which exists. This imbalance here now exists since this bit here has been filled. It's been filled up until this high. So, this sort of gap here still is unfilled. And obviously pairing this with our understanding of liquidity, this would make sense for the market to sort of maybe want to come into this area at some point to continue pushing down, as it's a well-priced level because it's filled imbalance. And also we know that we're subject to taking liquidity, and which obviously once the algorithm takes liquidity, it can use these highs, it can use them to transfer the money and to continue down, to keep putting in these bearish sort of structural lows. So you can also see that sort of prices, we sort of created a sort of market maker model here in a sense, where we've sort of built liquidity to the downside, built liquidity to the upside. And obviously, as we discussed earlier, price will usually take one side and then trade it up to the other side. So this would make sense, in which we could then sort of take liquidity and continue down and put in our next sort of leg of price movement. So price has sort of partially filled this imbalance, and since obviously one, it had only partially filled imbalance, and two, it did this push here didn't take any liquidity inside this push down, this sort of high is likely to be weak in a sense. So we could sort of deem this as a weak high. And also, expect this remainder of the imbalance. So obviously we can see that between here and here is the imbalance. It was partially filled in here. However, it will be fully filled once we hit the top of this line here, this top line up here. This would be when this imbalance has been fully closing. Obviously, you can also see that we have, like say, we have resting imbalance technically up here, where we've had this imbalance created. We've had this imbalance created between this low and this high, and it's been partially filled. However, since we've partially filled this imbalance, however, we've also taken lots of liquidity out. So although it's partially filled, the imbalance, we've taken lots of liquidity. So because we've taken a lot of liquidity, this high is likely to be strong, in which you can then see price comes and trades back into this level and fills the next imbalance, which gets sort of created in between here. This gets 100% filled or 100% mitigated. Prices are continue down. So we know this is a protected high since it's taken liquidity. And now we know that this price action here is efficient because this has been filled. However, this price action here isn't efficient, and also nor did it take any liquidity. This liquidity still exists here. So, we could be under the influence that the market may want to push into this level, come in. Obviously, we have the strong rejection off of the level. So you can see that the market has wicked the level, and obviously a wick, where the body doesn't close, the body of the candle doesn't close above the imbalance, has suggested that we've came to tap this imbalance and we've immediately tapped out of it, which is obviously good, a good sort of signal that the market is coming to reject this level and likely to want to continue to move away from it. And also, what do we know? The market moved into this level very aggressively. So once we have an aggressive move into a level which takes liquidity, we're likely to then get an aggressive move out of the level. And obviously, of course, aggressive moves leave behind fake demand zones like this. This is fake demand zone, since we don't have any significant liquidity inside of here for the market to want to trade down into and continue up. So, once we have hit a satisfying level for the algorithm and it's happy to sell off, where would our next liquidity point be? This low here. This would be our next target. We can see that inside of here, on the lower time frame, obviously we have this push above this sort of fake high that gets put in. And when we sort of look at this fake high, what does this high correspond to? Well, this high obviously corresponds to this demand zone here. However, since we've deemed this high weak here, obviously we'd also deem this high weak, meaning that any supply zone inside of here, so it could be this, it could be this whole range here, any supply zone here, which you can see we're getting these minor reaction froms, so here and here, we would consider traps, zones that are unlikely to play. So once we have seen, this sort of rejection of this level and then a sweep on this liquidity, we know that there's been a sort of trapping from early sellers getting involved off of this level. And we've obviously aggressively rejected off of here. Following the lower time frame liquidity cycle, we have taken liquidity. What is the lower time frame liquidity cycle made up of? One is obviously taking liquidity, and the second is building liquidity for the market to take next. So obviously we've grabbed liquidity, we've built liquidity in the form of this sort of lower time frame trend line. And what has gone on the lower time frame, you can see that we've mitigated this candle. Or in other words, you can see that imbalance that lies on the lower time frame between this low here and this low here is traded back into it and filled. So we've now filled this imbalance here. So this is where we can sort of talk about the fact that imbalance is a fractal concept which occurs on all perspectives of time. So you can see it happening on the higher time frame up here getting filled, and also the lower time frame. And obviously once we've filled that imbalance, price has also taken liquidity in the form of these lower time frame relative equal highs. I'm going to zoom in so that's obvious. You can see we've got these group of highs here, 1, 2, 3, 4, getting swept and filling this imbalance in here. And obviously 2, even a part of this tiny liquidity cycle where we've taken this liquidity, we've also subsequently built liquidity. So the market is able to take liquidity and travel to its next chosen location. So you could potentially be a seller on the lower time frame inside of here. Where is our target? Target is this low. Obviously, depending on how you would sort of adapt your trading style, you may be able to get away with a smaller stop loss than this. Sort of a logical place to put your stop could potentially be above this high, since this high is this sort of OB candle range. maybe you want to put your stop loss higher. I usually put my stop loss higher because I like to just cover sort of. Usually, one rule I actually do use is putting my stop loss above the sort of the bodies of the candles, since these are where the main orders lie in the sort of push. So hop onto the sort of higher time frame. Okay, so like 4, 5, 6, 7, 8. Okay, so it looks like this is the relative sort of high for that. So I like to just cover the bodies usually, just for probability, to keep me inside of the trade. Market begins to push down, and we now enter this trap level here. You can see we begin to get a little fake reaction out of that level here, and then we're going to come down to come lower. You can see that we have resting liquidity inside of these in the form of sort of lower time frame equal lows. And as we keep following price, on the lower time frame, you can see price coming up to take liquidity and fill imbalance inside of here. So this is not 100%, but partial fill of this imbalance. Ooh. Okay, so it looks like price wanted to come and fill that whole imbalance. And you can see as soon as we filled that whole imbalance there at this high here, we then can use that to continue down and eventually hit our targets. So, you know, price, this is sort of a high resistance move down. You know, originally we had a nice push and then we sort of tailed off. However, this is starting to become late in the day, you know, London close and then late New York session. So sort of lower volume at this period of time anyways. However, the trade idea played out perfectly. Came to hit TP, very nice. So we've, you know, talked quite a nice bit on imbalance there in the market. And we continue down to put in the next sort of leg of price action. Where we start to sort of build future liquidity points that price may want to trade into. So for example, like a level like this, where this is our internal range liquidity. This is our push down, our leg down, and then this is our internal range. Just make this a little bit darker so you can see it more clearly. However, you can see that this high would mark the full clearance of the internal range liquidity. You know, this may be a price level. You can see that price fills liquidity and then takes it out. So now we've taken a lot of liquidity, a lot of sell side. We may be looking to continue to push higher now. Trade back into sort of more sort of liquidity points. We can see that price in here came to clear this liquidity here. Also sort of built a lot of liquidity on the lower time frame, So we've got, you know, our liquidity area with built up liquidity for the future. So this is obviously how the liquidity cycle operates, in which we can look onto the lower time frame. Price creating imbalance between here, there, and here. Trading back up to fill it, creating more imbalance in here. This would be the full. This is a partial fill. However, this partial fill is simply just a build up of liquidity that can get swept. And then we get the full fill here. the money is transferred and it can continue down. So you can see that sort of imbalance is a fractal concept occurring across all perspectives of time. And if we drop in here again, we can probably see the same thing occurring. So let's push up here. Let me just find the correct time frame for it. We see in here too, price coming to fill imbalance. So we have an imbalance between here and here. And as you can see, that this price imbalance never got tapped. So we never had this partial fill. Simply just built a lot of liquidity and left behind this imbalance for price to begin to come and fill. And obviously we get that 100% fill. If you're not already sort of aware from what we've been looking at, a 100% fill on imbalance is the most likely area for price to want to use as an inversion point. So as we sort of trade up into this level, once we get 100% filled, see we start to react and reject off it and continue down. A part of the liquidity cycle, since we built significant liquidity, we trade up into a sort of repriced fair value area and we continue down to take out liquidity, just like up here too. Essentially, what is this? This is a inducement point for this order block here. I'm going to touch on this stuff more. However, if you drop down onto the lower time frame, you'd be able to see that this was just a higher time frame imbalance. So we can see this lower time frame, sorry. We can see this imbalance in here between this low in here, this low and this high. Come to fill this imbalance partially. Since this has been partially filled, we could expect price to come and fully fill it at some point. There you go. So price plays perfect into filling that 100%. And depending on sort of time of day or session, whatever, blah, blah, you can see that on the lower time frame, we create another imbalance here. You have liquidity being taken. And when we sort of refine this down to correct time frame. Okay, so the imbalance is actually here on the 10 AM. Between here and here, we can see this gets filled 100%. And we also take out liquidity. So you could enter off with the 100% fill this with this sweep of liquidity. I'm not sure how this trading goes, but you could put your stop loss above the high. Come down to target the low. The low is our sort of main liquidity point to target. However, you may want to look at something like this. Since this is a liquidity point with imbalance, could be a potentially sensitive area. However, the low is our main target on liquidity. It fits well with the liquidity cycle since we have built liquidity. Notice how when we take this liquidity in here, we come and trade back up, we take liquidity, we fill the imbalance, we always build and leave behind a nice liquidity point to come down to next. Start to trade lower. And there you go, finally hits TP. And obviously, when we look into the market here, we get that fill on imbalance again. Perfect mitigation of this imbalance. We never violate and hit our stop loss line for break even. Come and just fill this whole imbalance, and obviously we get that 100% fill. Once we have that 100% fill, we get the money transfer. So this high, which filled at 100%, gets obeyed. So we trade back into it and we mitigate this level. Why does this high here why does this high here get obeyed and we don't break above it? Since this is the high that 100% mitigated the imbalance, this is the high where the money gets transferred. So now we've hit this perfect equilibrium pricing. The money gets transferred between both transactors at this fair price level. And this mitigation here is what we call a money transfer. This high is respected and we get a mitigation. And then we trade lower. Liquidity cycle, tick. We build liquidity. We build liquidity. The market leaves behind all these clues. Even behind these traces of liquidity, which we're going to want to come target. Continue down lower. Plays perfect. So we got to introduce the money transfer concept. It occurs mainly sort of when we have raids on liquidity and fills and imbalances. So price comes in, we'll snatch some liquidity and we'll take out, say, this higher time frame liquidity point. You know, once we grab liquidity out, we'll then reject. This high is our strong high. This is where we're going to witness the money transfer. Could put in a fake break structure here. So we get this fake breakdown. Why? This is to create lower time frame liquidity. To then mitigate the money transfer, sweep out this liquidity at the same time, and continue down to take out the low. And of course, never forget the market building liquidity purposely. Take out. And obviously, we take liquidity here, then we take liquidity here, and then we can also take liquidity here. So we've definitely got enough fuel to move the market down. And this is actually a type of entry model here. You know, once we have a raid on liquidity and our sort of hard time frame bias makes sense to perhaps take a sell, vice versa, depends on the scenario. But we can have this sort of pre-market sort of manipulation before the hard time frame liquidity gets taken. Then we can get our sort of aggressive reaction, which confirms this high to be a strong rejection. We can get this inducement high here. Continue down. So, you know, what are our confirms here? Higher time frame liquidity point, lower time frame early liquidity being trapped. You know, this can be in the form of like a build up of liquidity or a market maker model. It can be a fake break structure, like a fake change of character like this. And then we come and take the liquidity. Well, we know that traders are likely to sell inside of here. Some type of early trapping on liquidity here. So that's, you know, what confirms we've got. We've got the sweep liquidity, early trapping, an aggressive mitigation, a lower time frame sweep, and a build up of liquidity to target. You've got your, what we got? We've got one, and we've got two, we've got three. In here, the sweep, we've got four, and the build up liquidity, we've got five. And then, is it in a key timing, a kill zone? Is it in a kill zone timing? Yeah. So then we've got our time confluence that we're within a time barrier, which we know sort of, you know, a time kill zone, which we know the market is more probable to inject, take liquidity and move the market in the desired daily direction as per the daily cycle, which we touched on earlier. So cool, we've managed to cover quite a good amount of stuff here. Talked on imbalance, talked on money transfer, talked a tiny bit on the entry model here. We're going to start talking about algo candles now. So essentially, an algo candle is a name for a candlestick pattern, which we use to determine which highs are strong, you know, which highs are protected on behalf of the algo in terms of when liquidity is drew and money is transferred from weak traders, you know, weak hands to strong hands. We can use algo candles to determine where this sort of transfer of money occurs and what high is going to be protected, high or low is going to be protected for price to continue to deliver after higher time frame draws on liquidity, etc. So top of the chart and draw up some diagrams. So let's just draw sort of basics of an algo candle. So say we have this liquidity level. Essentially, algo candles will form after large draws on liquidity. Obviously, this is also a fractal concept, so depending on the perspective, but it needs to be a large draw on liquidity for that perspective of time. So say this was a 15M liquidity void, we would expect this 15M candle to be an algo candle to confirm this sort of reaction and to sort of witness price then transfer money off of here on behalf of the people's stop losses who rested above this high. It's been taken by the algo, transferred into the hands of the algo, and then used to inject capital into the market to push it down, come and target its next liquidity target as part of the liquidity cycle of that particular time frame. So characteristics of the algo candle is it takes major liquidity, or it'll form after major liquidity. So some type of sweep of liquidity. So obviously in this case we have a major liquidity grab and also minor liquidity on the lower time frame liquidity cycle, which is where we've taken liquidity, we've built liquidity. In this case we take liquidity and we've also built liquidity. This is how the liquidity cycle operates. Liquidity being built on both sides of the market, one side getting taken and then trading it towards the other side of the market, take the other part of the liquidity. So this algo candle here, it takes significant liquidity. Significant liquidity. And second of all, is a strong rejection candle, meaning no body closes above the sweep. So we only want to see the wick sweep above the high and to close. Usually an algo candle will also leave behind inducement on the lower time frame. So in this case we've left behind this inducement high here, which then gets used for the money transfer to occur. And it will leave behind a nice sort of OB, nice order block with inducement, etc., or liquidity to take for the money transfer to occur, the price to sell off from there. Pretty easy to spot algo candles. In fact, at the example we were just looking at for structure traps, we can see some algo candles. Oh, apparently the data point is unavailable. That's not good. Right, where were we? Somewhere in there. Cool. So we can see that after this drawn liquidity here, and we also have it paired with a minor drawn liquidity. This candle here is going to let me go low. Yeah. This candle here is an algo candle. Since you can see that no body of the candle closes below the liquidity point, just the wick. We've had a strong rejection from this level, and this strong rejection confirms this low to be protected, in which price will likely, so say we have the algo candle form here, price will protect this algo on like this low on behalf of the algo, and then likely trade back into its range, which will see the money transfer and continue up. So in this example, you can see that. Let's get rid of this. You can see that this candle reaches here and it closes here. So we essentially create this range. You can see that in this range, price trades back into it and then pushes up from there. We can see that above this sweep on liquidity, we get an algo candle form above these highs. We have a draw on liquidity paired with this minor draw on liquidity where we have just a wick. No body closes, so we confirm the strength of this high with this wick, which could have sort of become you could have entered perhaps on the lower time frame. So we have then obviously our lower time frame inducement, drawn liquidity, paired with the mitigation of this algo candle range. And this is this a part of the liquidity cycle? Does it make sense in terms of the liquidity cycle? Yes. Since we've taken liquidity here, and we've built liquidity. So this is the lower time frame liquidity cycle. And obviously the higher time frame liquidity cycle, we took Frankfurt high, and we've took liquidity over here. And we have liquidity to target on the higher time frame too. Especially since we know that aggressive mitigations likely become important future liquidity points. So it doesn't mean they're weak, but it means in future there will be stronger points. So essentially this low here is likely to become a strong liquidity point at some point in time. So same as this high up here. Same as these two equal highs here. Or essentially this would be an algo candle here for this sweep of liquidity. Since underneath aggressive movements has stored a lot of orders or a large injection of capital into the market from where the algo has pushed price in its desired direction. You could have easily been a seller inside of here using this algo sort of candle confirmation to confirm the strength of this high, confirming this high to be protected. We trade upon the money transfer when price reprices itself into a more premium level and takes liquidity and fits the lower time frame liquidity cycle. Just like how we then create this imbalance in price, which if you actually look is support and resistance. We create this support and resistance level here. We have this support and resistance liquidity built up. We then get a sweep on. This is our internal range liquidity high here, which got liquidated for price to continue going downwards. Of course, I was talking about algo candles. Very strong way to confirm your levels after we get sort of nice draws on liquidity. So even, for example, this higher time frame draw on liquidity here. And you go into the higher time frame, which corresponds to the actual draw on liquidity. So this is a 2-hour liquidity high, or even a 4-hour liquidity high, which gets swept and leaves behind a 4-hour algo candle, in which you could then know that we could be a seller off of here. As per the liquidity cycle, we build lots of liquidity. And you could have been a seller off of this level here, which is essentially sweep of liquidity in here, paired with this FBG range here. this imbalance in the market. So obviously it's a fractal concept. It occurs across all perspectives of time. We're going to get talking about the next part of the video now. Getting a pretty decent way through. Hop on to talking about mitigation. So obviously we've talked about order blocks and stuff. We haven't actually sort of described it, but we've talked about sort of price delivery areas, breaker blocks a bit. We haven't talked about rejection blocks at all. We're going to talk about some more mitigation levels and also some types, touch on the money transfer a bit more, and touch on 2-push mitigations too. Cool. What we're going to be talking about in this part is just touching on mitigation more, talking about breaker blocks, some sort of a couple mitigation types, and just some more sort of market analysis. So let's hop onto the chart. All right. Cool. So it's up there. Cool. So right. So I'm just going to be looking at some EU price action back in May. So obviously we're going to touch on the breaker block, but what we're going to do is just sort of look at some chart sort of movement, and then when we come to sort of breaker block examples, we can sort of touch on it. So in this particular sort of price action on EU, I'll just get rid of this analysis down here, which is one sort of current analysis. Get rid of that to make it nice and clean. So in this current sort of market status on EU, obviously we have had a run on a large amount of sell-side liquidity across the monthly time frame. So essentially, hard time frame sweep of liquidity, and this has came down and also hit this level here. So if we could up the time frame, you can see EU has essentially came into this imbalance here. We've filled imbalance, we've taken out liquidity underneath this candle, as well as taken out liquidity underneath this low here, which you can essentially see is like a higher time frame market maker model being swept out, and we've started to react off of there, obviously this level below, and as a result we have left behind lots of liquidity as well as imbalance in price up inside of these high levels. So from here, we could potentially see a sort of push upwards long term in the higher time frame to potentially want to come and fill imbalance like this and take out buy side liquidity above these relative equal highs here. So dropping down to the lower time frame a little bit more. Cool. So where we are sort of in current price action, we have hit a monthly imbalance. So as you can see in here, we have the low of this candle and the high of this candle, which you can see we've just came into fill. So we've now filled this imbalance. You can also see that the market has left behind imbalances up here and stuff too. So, and obviously our hard time frame was bullish. So this level we're hitting now, since it's a monthly imbalance, price is likely going to want to use this as some sort of level to play a pullback from. So we may want to pull back into a certain level to then continue pushing up with buys to come and fill more imbalance and eventually come and take liquidity above these highs. So obviously you can see that initially we've started to sort of stall in price. Prices sort of began to stall around this level, building up sort of lots of liquidity, which we're likely to sort of want to come down and raid. And sort of wicking this level, you can see how price never has a body, no bodies of the candles close inside this level. So essentially, you can see we've came in and rejected this level aggressively in and out, and then we have came back up to this level side of here, we've came back up to this level and came to mitigate it. And obviously, as doing so, have taken out liquidity, and this liquidity here is what is going to be used to sort of want to push the market down to our next level. And you can see the market is essentially built a lot of liquidity underneath here. Plenty of relative equal lows down here, which we could sort of want to maybe look into selling towards to come target. And then obviously eventually, potentially price wants to come and say, take more liquidity under these loads. And then sort of down here, we have this daily volume imbalance. So essentially, we haven't really touched on volume imbalance too much, but essentially what a volume imbalance is, it's where we have an imbalance, however, through wicks. So there's no body of the candles here, just wicks. Essentially this wick imbalance in here. Obviously, you can also see we have a normal imbalance in price between this low and this high too. So price may want to come and sort of mitigate these levels and be drawn to sort of really price into a more fair valued area like this and potentially give a reaction. Could potentially give buys from here. So we react, we could push buys. Or the market could potentially react off this sensitive level, accumulate more liquidity and continue down into these levels and take out more significant liquidity to push up and then eventually take out this buy side up here. So dropping down onto, I'm just going to check, I am actually recording this time. Cool. So yeah, dropping down onto the lower time frame, we can see that we've had a leg of price. So this high here, taken out this liquidity, we've had this sort of leg of price pushing downwards. So if I drew up not that, if I drew up this tool here, like so, you can see the premium and discount of this, and obviously the midpoint being sort of 50% of the range. You can see that price has now mitigated this midpoint of this level. And you know, what has price done? Like so, obviously you can also see that we have another volume imbalance. So just like how we discussed down below with the wicks, see we actually have a volume imbalance here. This is a very strong sort of level to potentially look for sells for. Why? Because obviously the market is imbalanced. We've now hit the 50% of this range, which means we're at a good fair price level. So we could be sort of in a good position to look for sells. And then also when we drop down, you can see that we have taken out liquidity. So obviously this is our main sort of swing high liquidity point. And if you look, we've just wicked this level, signifying that strong reaction. Pretty sure if you sort of go up to the higher time frame, you can see that we've had like a full clear on this level. So even just looking at this candle here and looking at this imbalance just like this, see we've sort of mitigated perfectly into that. And you know, as per the liquidity cycle, obviously we've taken out liquidity, and we've also built significant liquidity below. So obviously it makes sense for the market to want to come and run buy side liquidity and then come down to target this sell side liquidity. So dropping lower. Obviously prices gave that aggressive reaction, sort of confirming the strength of this level. We've also obviously left behind a smart money trap. A lot of sort of high volume in here. Drawing up this tool again, you can see how prices came down and filled the 50% of this range. So we've filled the 50% of this range, and essentially, obviously we still have this whole other half to fill, but around this 50% level, you know, price may want to sort of start to pull back from, which you can obviously see we took liquidity and we start to pull back. And obviously we break higher here, most likely just a grab on liquidity for price. Cool. Cool. So let's just watch this price section. So obviously we are expecting this low to go first, and you can see here we have this large buy to sell range here with liquidity Obviously, you can see this imbalance here. We're likely going to want to refine this buy to sell range since it is quite big. So you could be interested in sort of this liquidity that exists here. Since on the lower time frame, there's probably some sort of OB up in this range here with this liquidity. It's off to make the chart cleaner. Cool. So price comes to take this liquidity and obviously essentially mitigate this range here. What's another sort of important thing the market has done here? You can see that price has generated liquidity prior to hitting our level. Then swept one side, had that aggressive reaction. You know, you can see that no body of the candles, only the wick has rejected this level, so signifying that initial strength off of this level. This is a good pricing level for the algorithm. I can sell off from here. And as if by magic, perfectly liquidate liquidity. Continue pushing down to take out our first sort of target for the algorithm. So we can sort of touch on the breaker block a little bit, since there's some key characteristics to the breaker. So looking at this demand here, what a breaker is when obviously a demand will flip into a future supply zone, or obviously a supply will flip into a future demand zone. So looking at this track level here, if we were to draw this across just like this, we can now use this as a sort of supply zone to sort of look to trade from. Essentially, when you look at this, this is essentially its own buy to sell range, so push up to break downwards, this whole range. So this breaker is essentially mitigating this higher time frame buy to sell range, just like this. You can see that in there. And obviously, another important thing about this is that we've had very high momentum, which means since there's not a lot of liquidity that exists in there, so price is less likely to incline and want to fill all of this. Since there actually isn't any liquidity to take. So if we were to push up, we'd at least want to come up to here, sort of see more sells. So, you know, potentially price did want to come there, could be looking at like this area for sells. However, my only concern with this is, since we've now taken major liquidity out on the high time frame, if price was to push up this high, I'd be concerned that this sweep of liquidity is actually like going to continue to push higher to take out more liquidity. So dropping down to this breaker, obviously what do we want to pair this breaker with? We want to always pair with liquidity. We always want to pair with liquidity, and you can see that we have this breaker getting mitigated and we have this inducement created. The inducement gets created here above this high, and we come and hit this breaker and take the liquidity. Obviously, what does the liquidity cycle do? It builds liquidity on both sides of the market. This is our sort of sign that this is likely going to play. We're going to want to continue down, and this isn't sort of a money transfer to continue pushing up. However, it's essentially just trying to cause a pullback, coming into a better price area to continue selling off, leaving behind liquidity to come target. So coming into this level, obviously you can also see that trendline liquidity has been made. There's lower time frame entries available inside of here. You can see one, we have a sweep on liquidity in the lower time frame here. Two, we have this sweep here. So this is more likely to be your entry. Since what have we actually done? Well, we've taken liquidity, we've hit price delivery area, in this case a breaker block. We've aggressively had a reaction out of here. We've actually left behind a lower time frame smart money trap caused by this aggressive push up, and we've swept lower time frame liquidity in here. Cool. This could be a nice sort of sell position. you know, obviously looking at higher time frames for sort of potentially sensitive areas. This level may be sensitive for a reaction, since this sort of liquidity paired with this imbalance in price, this may be a sort of sensitive area for the market to come to. So we could sort of say we could TP from here. Price obviously delivers downwards. So let's just delete some of this analysis to keep things clean. Clear price action at. You now see that we still haven't delivered to this level on the higher time frame. We still haven't came to this level, the sensitive level we were looking at. So, you know, we could still continue to see sells. We've obviously left behind this sort of, if I was to just sort of make this slightly lighter so you can't see it as much. Cool, just so we can sort of keep track through here. If I just get rid of it for a second. So you can see that inside of here we have this imbalance in price between here and here. This imbalance obviously builds liquidity, like left behind liquidity, the target. So, you know, in terms of the liquidity cycle, we've taken liquidity. This is obviously a retail pattern as well. So we've taken liquidity and we've built liquidity. So sells off here could be sort of high probability. What else have we had? We've actually had a fake change of character in the market structure. So you can see that we've pushed up and we've had this change or this break structure, leaving behind the supply zone. However, obviously this is a trap, so this is a fake break. How can we establish this is a fake break structure? Well, Frankfurt high swept Asia high, and we know Frankfurt high is usually weak. So if the Frankfurt, I think we touched on this already, but if the Frankfurt range sweeps the Asia range, then that's likely going to get swept again. So say this is the Asia range, Frankfurt high sweeps it. However, because this is Frankfurt high, we're likely to see another sweep on the Frankfurt high liquidity and then continue down, come the target. We've had some nice sort of trapping confluences there. You can see price coming and hitting our level. Get that 100% fill. Notice how this doesn't fill the level 100%. In fact, it just leaves behind liquidity, and then we do come and fill it. And as you can see, look, once again, you know, no body, no candle bodies, just wicks, signifying that aggressive sort of reaction off of this level. And you can obviously see where's the lower time frame confluence at. Well, see, we leave behind beautiful liquidity here. And we have this beautiful unmitigated order block here. Just like so. Price comes in. Smack it off the candle closure is what I usually do. Just so I can allow price to react aggressively off of here. And confirm that this is likely to go down. Well, that's fucking stupid. Sorry guys. Data point unavailable. Apparently, let me just quickly go back and find out where we were. Somewhere. It was in here, wasn't it? Yeah, it's in there somewhere. Cool. So you can see price comes down. That plays very nicely. Just remember, guys, this is all in the higher time frame bias, all part of the higher time frame levels. We're not playing these stupid like points all around here. You know, we're letting price. It's just like algo structure, like we discussed earlier. you can see that we print, we print like lows, highs, and stuff, and we're liquidating. We liquidate like this, and we go down. We create this next move. We create structure. We liquidate. Come into a nice, well-priced level, and we come down. Obviously, where would you partial this trade out? Well, you're going to want to partial at this level here, because this is a sensitive liquidity point, as this is sort of clearing out all of this liquidity here. This is your most likely level to partial, probably potentially even Asia low just for safety. But you're probably going to want to partial around there. You can see we have this unmitigated candle here. Make this a bit more cleaner. You can see that it has imbalance inside of here, within here, and obviously all this liquidity. So the price may want to give a reaction, which you can see it does. However, our long-term goal is to come down here, so we start to shift market structure. We have a break of structure here. However, this break of structure is just fake. We've came in with broke structure. It looks like we're reacting off here, but overall high time frame, we want to come down here. So this demand zone here that gets left behind in here is a trap. We come down, and whereas this here is actually just a grab on liquidity. Another way we know that is that you can see price comes and hits a breaker block. Been discussing. So if I just get rid of the Asia for a second, you can see that we have this breaker candle. Yeah, this demand which broke, came into a supply. Obviously, we have that nice aggressive push down. Come and clear out liquidity. And just make this a little bit more visible. Come and clear out liquidity inside of here. See, we can sweep this level here. We also come and fill this imbalance in here. And we also build liquidity, so obviously you can see it follows the liquidity cycle very well. The price breaks down. There you go, and sort of comes up, trades back into this imbalance in this order block, and pushes down to our target. Cool. So obviously you can see that this level, this high time frame level that we had marked in here, obviously didn't really give any sort of reaction, so we can pretty much say goodbye to that level. We're not particularly interested in that anymore, so we can get rid of that. That cell was up there somewhere. These are sort of the trades that we've been looking at currently. So these shorts. Right, so next stop on the higher time frame is going to be this low here, and eventually this low here. However, you may want to keep an eye on this level. It's a nice unmitigated order block candle, and it has immediate liquidity. This is close by. If we took this, we could potentially see a reaction, even if it does sort of just fail and forms a pullback, continue down. Still a sensitive area that we're going to want to sort of keep an eye on in the market. What is the market currently doing? So part of it. Cool. So we've got this liquidity point here. This is what I am interested in. Why am I interested? Well, let's take a look. It's gone to the 2 hour. There you go. Perfect. You can see this imbalance paired with this significant liquidity point. Also pretty much lines up with this here being a breaker block, a high time frame breaker. The liquidity cycle. Market is building liquidity. We're generating fake highs like this. Oh, beautiful. So we perfectly tap this level.
See, there was nice buying opportunities here too. If you were to sort of get involved into a buy to anticipate this to sort of push up and take this liquidity. Quite a nice potential buy opportunity inside of here. Obviously, the liquidity cycle, leaving behind liquidity, taking liquidity, pushing up. So we come into our level, we have our aggressive mitigation, no candle, just the wick hits the level, no body of any candles. Take out this fake high above here as sort of extra fuel. Come up for one more. Push into this level by the looks of it. Just like I said earlier about this breaker, so it looks like price wanted to come and hit this breaker block. You can see we've hit breaker with liquidity now. This imbalance here, like we've still only had a wick above it so far. We're still sort of rejecting the balance. Cool. So lower time frame, obviously we've had our rejection. We've built liquidity. And the liquidity cycle we've talked about many times now. We take liquidity and we build liquidity. So we have a draw on liquidity here, which mitigates this OB. Like that. Could give you a nice sell opportunity inside of here. Take the market downwards. First stop this low, second stop these two equal lows here. Third stop this level here. Fourth stop our higher time frame level down here. This is our main. This is going to be our main target though. Price is leaving behind another nice liquidity point. Paired with imbalance here too. Be a nice level to take a sell from. Obviously, as per the liquidity cycle, we're building liquidity. And we're taking liquidity out. Nice big stop loss. Covering above this candle high. Eventually we hit TP. So just sort of based off liquidity, you can see these nice entries along here, which we're just following the higher time frame direction of sells, playing these well-priced areas. We're getting in off of the well-priced areas. We're not getting in down here. We're getting in up here. Target this. Cool.
Yo, what's up, guys? First of all, congratulations for making it this far into the recording. We're quite a decent bit through. We're now going to start hopping into an entry model, which appears very oftenly in the market, usually around 3 times a week. However, to be fair, this model pretty much occurs daily. As long as you're not getting some dodgy just price action for the day, this model is going to sort of play out on a daily basis. So we're going to cover an entry model, which I use myself, and obviously you can take influence from. Obviously, gather your own data, do your own research. Don't just see the model and start using it, and then you need to have genuine data. Literally have the most important thing about trading is having data to back up your ideas and your concepts. You can't blindly take trades. it's pointless, and you're not going to learn. You need to genuinely have data, lots of repetitive sort of entries with the same strategy over and over again to study all market conditions as well, because like you need to really get a good insight to your trading. Like how many is the maximum amount of losses you can take in a row? Like how much is the maximum possible win streak you can take in a row? These are all sorts of things you need to know that your strategy is normal. Like I know for myself that like over 10 years of data that I've back tested recently, the max losses I've taken in a row across 10 years was 4 in a row. So I know if I'm ever in 4 trades in drawdown, I know that the win is going to come soon. Like it was all these psychological parts of data which will help with your system. Also know that I can also take 4 wins in a row maximum. That's where I usually top out. Like that'll be the end of my win streak, 4 wins in a row. But now I've got 10 years of data back tested, plus obviously like that's just for GU as well. And I've also got like 4, 5, 6 years of EU back tested. Obviously I've got live market experience for nearly 3 years now, and all sorts of case studies, self-study, extracting information from everywhere really. So you've got to have the data to back it up. You've got to have genuine statistics on the entry model, and what is a common theme throughout losses, what is a common theme throughout wins, trying to stratify it and make it as mechanical and as objective as possible. So it's so easy to follow, like to the point it's not even difficult. Like it's so hard to break and not follow the strategy because it's so easy to follow it. Like my strategy is tick boxes, so it's pretty hard to not stick to the plan, because if I don't tick the box, I can't take the trade. So I need to tick each confirmation, tick, 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 and once it all ticked, I can take the trade and it will make sense. So it needs to be as mechanical and as objective as possible. You have to have data to ensure the profitability of the strat, and to be able to sort of differentiate which trades are going to be good and bad, and eventually sort of narrow it down to the best sort of model. And then once you get it down to some good blueprints, all it takes is constant refinement of the same entry model over time, and you can up your win rate in small amounts. So you can make a slight change to your strat, go back test it for a year of data. And bearing in mind, guys, it doesn't take long to back test a year of data. Like on average, I get through 1 year of back testing data in a month, and that's just with like a couple hours a day. So you can easily get through like a year, 2 years, a month of back tested data. Highly recommend using FX Replay, by the way. It's goated. But obviously get live data with demo on your strategy too. But once you make adjustments, go back test a year of data. A year is usually the minimum you want to get data on your strategy. And you can sort of pre your win rate and see how it sort of changes with time. Every tiny little adjustment you're going to make is going to be like a 1, 2, 3, 4, 5% change in your win rate, up or down, whatever. So like you need to really sort of work on refining it, and over time the small sort of adjustments will add up to make like a really big change in your trading, and also just your overall confidence. So when it actually comes to taking trades, you're actually confident in taking the trade. It fits the plan, it fits the strategy, and you have the data to back up the fact that the strategy works long term, it's overall profitable, etc. So for example, I know for me, the average win I secure 6.32 RR. So like I know that I ain't trying to be holding trades longer than that without partialing, and I wouldn't want to close too much early because I could be sort of maximizing the profits by aiming for my average RR. From my data, I know my sort of strike rate. So this is wins plus break evens divided by wins plus break evens plus losses. So pretty much how many trades do I not lose is around 68%. So 68% of the time I'll not lose a trade. So it'll be either a win or a break even. And then 55% of the time it will be a win, and 45% of the time it will be a loss, which means 13% of the time it will be a break even or whatever. So you have to get sort of data, and that's obviously across like 10 years. My strike rate ranges between 50 and 60%. My win rate, sorry, ranges between 50 and 60%, with 6.3 RR on average. So, you know, these are things you have to get data on your strategy, and obviously from mathematics, you can plot an equity curve and ensure sort of your edge is profitable long term. You need to understand how your strategy performs on a daily and weekly, and monthly and yearly basis. I know, like, my strategy will typically perform between 12, usually like between 8 and 12 trades a month. So looking at about 4 to 6 wins. That's about 50% strike rate. So 4 to 6 wins a month, bringing in, you know, around like anywhere between 20 R on average, usually like 15 to 20 R a month on average. I know there's months where I've backtested data and I've took a significant, much more break evens than usual. I know that Mondays are my worst trading day of the week. Fridays are my second worst trading day of the week. Tuesday, Wednesday, Thursday are all roughly about the same. Thursday is my best day of the week to take trades. You have to get these little bits of data to sort of justify your strategy, to know how it performs. I know that there is also the possibility that I can have a losing month, because in August of 2019 on GU, my strategy was -2 RR, so 2 losses and like 2 break evens, 0 wins. So like over 10 years data, like I found out there was 1 month of price action where my strategy did perform negative, but of course all the other months were all like sort of usual. So my strategy will perform around 150 to 250 RI a year, depending on sort of how many trades there are usually, which on average is about 110 to 130 trades per year on average. So you need to get, you know, data, essentially. That's what I'm trying to get at. You need to actually understand your model and be able to reciprocate it every time, and also talk it to yourself. You know, these figures should be on top of your head. It shouldn't be a difficult task to identify when you're taking a trade. It's like, should I get in it? I don't know. I'm going to wait for this. I'm going to wait for that. Like, bro, if it fits the plan, tick the box, get in the trade. It's not difficult. It's all you got to do. You know, it takes a lot of the emotion away. Like, it's pretty easy to know that you're doing something wrong. If you sit there and you take a trade and it doesn't fit the plan and then it takes a loss, all you've got to do is sit there and look at the fact that you didn't tick all the boxes and it didn't make sense. Like, it's easy to just be like, yeah, you're being a dumbass. Like, it didn't fit the plan, so I shouldn't have took the trade, essentially. It's easy to do that. So let's hop into the strategy now, stop waffling. Legit, there's 5 key points. They all evolve around, obviously, the 2 most important things in the market, time and price. The first tick box is nice and simple. It is literally just our POI, you know, where is our key level at? This could be, obviously, this all needs to be what identifies a key POI. Is obviously this takes into account that it's in line with high time frame bias and it makes sense. Like, this might, you know, key levels are levels which make sense in terms of high time frame bias and, you know, price action, directional bias, etc., etc. So, like, you know, this could be, say, based off of algo structure, like a draw on liquidity, where we look to get involved and continue taking price up. You know, these could be your usual sort of draws on liquidity wherever in the market, blah blah blah. Draws on significant areas, you know. So once price sort of delivers its direction, so our sort of movement was to take out this buy side liquidity, for example. Now that target has been initiated, we can continue selling down, etc. You know, our order blocks with inducement breakers, blah blah blah, like just a key level. You know, it's usually visible on the 15M, 5M, 15M to 1 hour levels you can play off of. Obviously, we're going to look at all this on the chart, but you need your key POI to actually be playing trades off of. Then we need the liquidity cycle. So does this trade make sense with the liquidity cycle? So say we're looking to take a trade up here. So, okay, so we've got our intraday key level, right? Because we're looking for sells off of this buy side liquidity. Does it have confluence in terms of the liquidity cycle? Yes, because we've taken short-term liquidity. So we've taken in terms of liquidity cycle, we want sort of some type of liquidity to be manipulated on our way towards delivering to this price level. So on our way to targeting this buy side liquidity, we want price to build liquidity. So when we do sell, we have liquidity to target. And also we want like some sort of early sort of manipulation, some sort of trapping beforehand. So essentially what the liquidity cycle is the market builds liquidity on both sides. It takes one side and it takes the other. So essentially this could be a market maker model. We could have essentially, we could have price come up. We could have fake break structure. This is a part of the liquidity cycle since it leaves behind traps and this gets swept out, leaving behind liquidity, etc. So, do we have some sort of early liquidity model where people are getting taken out before our level? Your fake breaks of structure, vector candles, support and resistance, liquidity, market maker models, all them sorts of things that we covered earlier on during the call. Our next thing is the algo candle. So literally paying attention to how price reacts off of the level. We get our little market maker model. We build up liquidity here. How does price react? Obviously the way we want price to react off of our level as we initially mitigate or draw liquidity is in an aggressive manner. We want that quick, snappy in and out. As price starts to move out, it's likely for price to want to continue to keep moving down with this momentum. It shows that sort of rejection off of that level on behalf of the algorithm as sort of money is transferred from weak to strong hands. So we want that aggressive in and out, known as our algo candle or algo mitigation, as we have spoke about during the call. So we're just simply putting things together. MSU, this just means manipulation setup. Manipulation, pretty hard to type with a mouse, but our manipulation setup. So in terms of this, what is a manipulation setup? Well, what we want essentially is as we take liquidity, we want some lower time frame manipulation. So for example, a little lower time frame sweep on inducement, which would give us an entry, an area to actually get involved. This would be our technical area to get involved off a lower time frame sweep. We want some sort of manipulation set up inside of here. And finally, we want time. Well, it needs to be within a key time, and you don't want to be trading a random time of the day. So based off of our sessions that we sort of studied at the start, so in our London kill zone timing, anticipating sort of maybe a protected daily high or low of the day to form at our sort of desired entry level, New York timing, our trap timing, etc. like that. So that's what we're sort of interested in. Also the 90-minute cycle, which we haven't actually dove into in this call. However, since I'm feeling nice, I'll drop my indicator here real quick. You have to be quick and pause the video, note down these little time windows. Obviously these are all in GMT, so convert, but essentially this just goes from London to the end of sort of London close, so London and New York, so it's just essentially for the whole day of price action. You'll need to screenshot these and pay attention to these times. Obviously for me, I've got it as an indicator which will appear in terms of the little box. And yeah, these are sort of our little 90-minute cycle window timings where you can look to get involved in these sort of every sort of initiation of each move. You can see that price initiates moves, that most moves are initiated at the beginning of the 90-minute window, so the 90-minute open each time. we're initiating these moves at the beginning of the cycle each time. So what we want to be smacking trades off the opening of the 90-minute windows, so we can start smacking with our little tiny macro sort of confluences, etc. So yeah, essentially screenshot them timings and make sure you note them. It's really easy to remember. It's literally the 12th minute of the hour to the 30th minute. So 12 to 30 and then 42 to the next hour. So yeah, and obviously our other time aspects are a kill zone timing. So if it's in a kill zone and or if it's in the 90-minute cycle, then essentially it fits the plan. So we've got an aspect of time, we've got an aspect of a higher time frame bias, we've got lower time frame liquidity, we've got candlestick confirmation to confirm the rejection and confluence the strength of our level, and then we have lower time frame liquidity in the form of MSU. You can also enter sort of as a more risky trade, so a higher risk trade. You can get rid of the MSU, so you're essentially executing off of levels. So once you get the rejection, you can execute your trade off of the actual rejection of this POI. You can get in your trade without having to wait for MSU. But however, that's obviously a more risky entry. Lower risk would be confirming with your lower time frame confluence and getting involved like that. That'd be a low risk entry. But obviously for a type 2, you can eliminate the MSU and go for a higher risk entry. And that is obviously what you need to build actual rules around. You need to have rules around this and when you execute one and when you execute the other. So essentially we've run through the strat in terms of the actual tick boxes now. Obviously it's pretty easy, like I said, it's very easy to stick to the plan because it's literally just 1, 2, 3, 4, and 5. So it's pretty difficult to not obey your strategy and stick to your plan. We're going to sort of pull up some markups now and begin studying some price action. And take a look at some examples. So let's do that, and then we'll hop onto the chart and look at some more examples on there. But let's have a look. Let's pull up the old data. Obviously, I've got absolutely tons of data in here of screenshots, and what you need to do is you need to reciprocate your entry model so much that every single trade looks the same. So like, this cell looks exactly the same as this cell. Look at this cell. This cell looks exactly the same as this cell. This cell looks exactly the same as this cell. Like, they all are the exact same. That's how you need to get your strategy. It needs to be easily reciprocated, where every trade literally looks exactly the same, just in a buy or a sell sort of format. Literally every single time. So cool, let's just dive into a couple of these. We'll screenshot them and get them added up. Let's find a nice beautiful trade to sort of begin looking at. Cool, let's just begin with this one. So we'll take a look at quite a lot of them actually, and then we'll actually hop on the chart and look at some. So for example, this cell here, right? So obviously you're gonna have to trust me on this. I haven't actually got it on the screenshot, but we have our key POI, which is paired with obviously this higher time frame draw on liquidity. So it's obviously some sort of POI which has liquidity within its proximity, which gets swept out, as you can see. So we've got our number one tick box. I'm going to pull up this and just stick it over here somewhere so we can keep track. So we've got our key level, Cool. So now, in terms of the liquidity cycle, have we had short-term liquidity taken out and built liquidity too? Well, we've had this short-term high taken. If you actually look for added confidence, we also had a 2-push mitigation. So as we talked about 2-push mitigation earlier, so we've also had a 2-push mitigation. So, we've had short-term liquidity taken out, and we've also built short-term liquidity. We have equal low liquidity, relative equal lows, and we've also generated this trend line of liquidity here. So we've had our intraday key level, we've had liquidity taken out and liquidity built towards our trade direction. Algo candle, yeah, we have our 2-push mitigation and our quick aggressive in, and we wick out. Marked by this candle here. Our MSU, obviously, yeah, we sort of begin to form this structure like this, low, and obviously think about algo structure. This has been respected, this is normal structure. So obviously we wait for this to get liquidated and continue down, and this is where our entry can be on the liquidation of that. And when you look at the chart, this is 1 p.m. here. So 1 until 2 GMT. This is the New York Open kill zone. So you can see that we've got the kill zone timing too. And that obviously perfectly fits this strategy. Nice and easy trade to look at. Let's put up a bunch more just so we can sort of start reviewing some nice trades. Oh, okay, this one's actually got a hard time frame. It's fine, I've got some clean ones. These are all pretty clean, to be honest, but let's have a look at this one then. Cool, so let's pull this one up. Stick this over here. Okay, cool. So obviously we have our high time frame draw on liquidity, which you can see we've had a draw on liquidity. So we've got that, and we've got our liquidity cycle. Yeah, we can see that prices made this AMD, so accumulated. It's essentially a market maker model where we've built up liquidity in this little range, built liquidity in the range. One side gets taken and we trade it towards the other side because there's resting liquidity down here. This also leaves behind a smart money trap. So we've got our liquidity cycle. We have our wick rejection from this level. And we have price obviously build liquidity, which is added confluence. So we've had our wick, have the MSU because price pushes down. We come up, we come down, we create equal lows. We come and sweep and mitigate this algo candle, in which we can grab our entry inside of here. So we've obviously got perfect technical analysis here. Let's just go through a bunch of sort of examples of the strategy. It's exactly the same thing, like literally every single time. Cool, this one we've actually got like a hard time frame image. So we're going to take a look at this one. So obviously our buyers in this, we have this candle here. Let's just change my color to like red or something. So we've got this candle here, and this is paired with this liquidity. So obviously on a higher time frame, this would look like this. We've got this push up, we've got loads of liquidity, we've got blah 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 blah, price action, blah blah blah. We're taking out this liquidity and mitigating this level here. So we're clearing out liquidity and we're mitigating a nice candle. So this is our hard time frame intraday key level. Obviously we have confluences around, we've built equal high Asia liquidity, we've got like this trend line liquidity, etc. We've got plenty of liquidity resting above here to come target. Do we have our sort of lower time frame like liquidity cycle or liquidity trapping? Well, you can see that prior to hitting our OB and taking out our liquidity, just before taking liquidity and hitting our OB, we have the Frankfurt low being swept out. So as we spoke at the start of the call around Frankfurt high and low being used as liquidity, you can see Frankfurt low being used as sort of early inducement. So we have our, let me just pull my snip up. So we've had our intraday key level, had our liquidity cycle because we've swept out early Frankfurt low and built liquidity above Frankfurt high, obviously, which exists, as well as relative equal highs above here. So we've got our lower time frame liquidity cycle, which is, you know, taking early liquidity and building liquidity to target on the short term. So obviously our higher time frame target is above these highs, but we've now got short term liquidity being built up. So that's why it's 5M and 15M, because it's trying to signify we have like short term liquidity. So it's not a part of our higher time frame liquidity buyers, which is to come take out these equal highs, but it's our lower time frame. We have our algo candle because obviously this rejects with a wick. You know, it's a nice, what is, you know, why do we like a wick rejection? Because a wick is signifying that aggression, that we've aggressively came in to a level and we've came out in this, like in the shape of a V essentially. You know, we've come in and as soon as we've hit it, it's obviously a sensitive area and we've reacted out, which is, you know, confirming this, starting to form strength around this level. We've had this. And then if we drop down onto the lower time frame, well, this is actually very, very low. You can see inside of here, we have this liquidity being built here. This gets swept out. And then we buy from there. So essentially, what is this? You know, we've had that sweep of Frankfurt low. We've had our aggressive wick. We've pushed up like this. We've come down. And then we've built liquidity by them 3 candles in here. And then we've swept down and gone. So we've had our lower time frame manipulation set up. Obviously, a part of that, we've also built liquidity, which you can see is this trend line here. You know, we've built that liquidity. So we have our MSU and time. This is inside the macro timing between 7:12 and 7:30, because this is 7:30 here. So we're inside our 90-minute macro window and just pre-London open session. So we can be expecting sort of a large injection of capital to be coming into market soon, just before London kicks in. So obviously, yeah, beautifully fits the plan. Absolutely wonderful. It's literally the same tick boxes every single time, and obviously you can eliminate obviously eliminate the MSU and you take your risk entry in here. So obviously off of that, as we sweep the Frankfurt low and we aggressively react and we close, the candle closes with a wick, then obviously you can enter off of the actual strengthening of the reaction. So as soon as we react and we aggressively wick off it, you know, you might want to confirm this by, like, instead of looking at lower time frame wick, maybe you want like the 5M candle to wick, or you want the 15M candle to close with a wick. You know, you may want to signify a bigger, sort of more high time frame prominent candle to reject off of it, just to sort of ensure the strength of the level a bit more. Maybe something you want to look into. You know, obviously you've got to study all of this stuff. So good luck and have fun, because takes a long ass time, and I've been there a million times. I've been through it all, and I'm still going through it all, and I still study the market every single day, day in and day out. So yeah, just because I'm teaching you doesn't mean you can't do your own study. You've got to definitely go and do your own study. So just ensure you're doing that, guys. Make sure you're getting your data, just so you can actually prove to yourself that what you are doing, you know, works, and you have the confidence in this. So back onto another chart example. So obviously you can see we have our intraday key level, which is this candle, this algo candle. It takes liquidity, and you can see we have all this internal range liquidity above Asia high. When you actually look at this, this is a massive AMD. So on the higher time frame, this would look like this. We have our AMD, we have that break lower, and then we come up like this into here. And then we continue down. So this AMD here is essentially this here. So obviously this is a very sort of key strong level to be looking at to take sells and continue to our target, which may be this liquidity point in terms of actual structure. So we have the AMD, we push down, we come up into here. So essentially this break a structure here is essentially fake. It's a fake break structure because this is like a market maker model. So we build liquidity above the highs and the lows. We take the lows out, and this is a fake break structure. Fake break, and then we come up, and obviously this supply zone fails, and we come and take liquidity. And some traders may view this as a chop now, like we've took the low and we've took the high, so now they might look for a buy, whereas actually it was all just to come into this level here, and now this is going to fail here. So you can see how we're just continuously manipulating our traders. You can see, so you know, the price action before we mitigate our level that we're looking to sell from, you can see price has come and took the high and took the low. So we've had actually a fake chalk here. You know, we've had a fake change of character in the market here, and then we've continued up. We've had our vector candle, which is left behind a smart money trap. So obviously we've got our intraday key level, which is here. Got our liquidity cycle because we've had a fake break structure. We've built trend line liquidity, and we've left behind a smart money trap. So we've got plenty of lower time frame sort of liquidity cycle confluences. We also get our 2 push mitigation, so that's a big tick. Algo candle, you can see that we wick off of this level up here. We come in, you can see it's aggressively in and straight out. So we wick the POI. So we've got our algo candle. And you can see, so as we mitigate the level, so this is our level, as we have that 2 push, we come in, we push down, and we leave behind this. I should have probably drew this somewhere else. So this is our level. You know, we have that 2 push, we come in, and we come down, and then we build this liquidity like this. We come up. So you can see we sweep liquidity here. So this high here gets swept, and we obviously build lower time frame liquidity all here as well. So we've got our manipulation set up, which is this sweep of lower time frame liquidity in here, and this is inside of the macro timing. So this looks like the for draw a line here. This is 11:42 to 12 o'clock 90-minute macro window. So obviously that fits the plan absolutely perfectly. And you know, like we said always, if you remove the MSU, so you're not looking to get involved off here, you would have simply smacked it off of this reaction here. So you could still be in the seller off this level here. Just maybe sometimes have to sort of let price play out a bit to because it may still want to give lower time frame confirms like this. However, if you're just in a sell up here, you can just wait it out and it will eventually run and come to your liquidity target. So, you know, sort of continuously covering the exact same thing every single time. Just like this entry here. Literally the same thing over and over and over again. You know, we have our high time frame liquidity, which is this level here. You can see we build liquidity and then we liquidate it. So we've had our intraday key level, which is this liquidity. We have our liquidity cycle because we build liquidity above equal highs and we also liquidate. We've had actually a wedge pattern here. So it's where price builds like a wedge. That was a terrible drawing. So it's like, you know, building a retail wedge pattern. So here and here is our little sort of liquidity cycle trapping. our algo candle by this very aggressive wick, then our MSU by when we drop down. You can see that we've had liquidity built up in these lows here and this order block here. So we've had that, them equal lows made, pushed up, came down, reacted again. We've essentially done this on the lower time frame, swept it out in there, mitigated this OB. So we've had our MSU, and then final piece of the cake. You can see that this is 8 o'clock here. This is 9 o'clock here. So we're in the London Open kill zone. This is obviously GMT time, so 8 in the morning till 9 in the morning is the first hour of London, also known as the London Open kill zone hour. So obviously we're in the kill zone timing for London sessions. So bang tidy, got every confluence, the time confluence ticked off. So yeah, some nice examples there, guys. 37 minutes straight just waffling about the entry model. Hopefully that's been sort of a good insight into the entry model and inside of the trading. So obviously you need to get your own data on this. Watch this video as many times as you can, and obviously don't feel obliged to watch every single part. Like, just watch the whole thing and then go back and re-watch the parts which you need to sort of re-watch and study the most, essentially. You know, what parts you don't understand or what parts you're more interested in and suit your trading style more. Don't replicate my trading. You know, everyone has their own way of trading, so just make sure you find what works for yourself. In a way, you know, this is just what I found out myself. Like, this is what works for me. No one else sits here and like has this entry model, and it might be different to what some people have or some people think, but you know, it's just what works for me, and this is my perspective of the market. I haven't gone and learned from some courses and just reproduced the information. I've just sat here and learned from myself and found the entry model and the strategy that works for me, and it gives me enough trades to sort of pass challenges and make good returns each month, etc. And essentially sort of have profitability in the market across a weekly, monthly, and yearly basis. So obviously, yeah, just make sure you guys are studying very hard. Take notes. Literally, it needs to be pen and paper. You need to go back to pen and paper and writing everything down, hopping on the charts and backtesting this stuff every single day until it's literally second nature, and your eyes and your brain are programmed to see and identify the concepts which I teach. Essentially, it will then become pretty much a language, and you'll start to understand the market just like a language, and you'll be able to read it and just see it, and wouldn't have to think twice about the entry model because you already know it off by heart. You already know exactly what you're looking for, and you already know the exact criteria on how and when you're going to get into a trade. You haven't got to worry. Yo, what's up, guys? Just wanted to hop in and say thank you for watching the whole bootcamp call. Now I've got to the end finally. It's been a long journey. A lot of time put into this call, sort of just recording everything and planning it all out. I hope that every single one of the people that bought this got as much value out of it as possible. Be sure to rewatch the necessary parts that you need to, and of course gather your own data on everything. Make sure you're making notes and studying hard. You can't just watch content and just go apply. You need to go study it. You need to make notes. You need to draw. You need to hop on a chart and backtest and get data on stuff. You can't just sort of watch something and be like, oh yeah, I get that, and then go apply it. You need to actually sort of test it and get an understanding, rewatch, and continue studying. And you know, hopefully I've changed your perspective on the markets, and hopefully I can influence your success in trading. So I'm very appreciative to everyone who's bought it and stuck along and watched it. All the best luck for everyone who watched this in your trading. And of course, if you have any queries, just give me a message on Instagram. JJ Weldon is the name. Just search it up. Yeah, give me a message if you've got any queries or questions or any sort of concerns at all. I'll do my best to help out. I'm pretty active with my replies. I tend to get back to everyone, so feel free to do that. And if you are interested in more information, then give me a shout, because the ebook is also very valuable, and it may be better to sort of digest the content in another form. And, sometimes it's good to take information in different ways to sort of help your brain perceive it and be able to apply it. So maybe reading an ebook and going through it like that may be beneficial too. But obviously, this call has essentially everything you need. So hopefully you're all set now and you can go study, put your own twist on things, get your own data, be able to trade live markets. And with hard work and determination and discipline and consistency, you'll be able to get somewhere. So thanks guys, and I'll see you later.